in NYC presented by Metaplanet. Thank you all for being here. My name is George McHale. I'm the Managing Director of Bitcoin for Corporations, and we're very excited to be here in New York with you all. We have an incredible lineup and a packed agenda today. For the next 5 hours, you're going to get to hear from really the most important voices in institutional Bitcoin adoption. And if you've looked at price action lately, this is a very timely conversation. So very, very interested in what the conversations are going to sound like in this environment. So I've encouraged our speakers to not hold back. I've encouraged them to just lean in to the fact that we are in a bear market. And for a lot of the newer institutional players who are coming in, this is really a great entry. So a lot of those people are in the room today. And so let's go ahead and get things started. A couple of quick housekeeping items. Restrooms out this door, back towards the elevators to your left. We have private meeting rooms on the 5th floor, so if you have a scheduled meeting, you'll want to head to the elevators, go down. Snacks and coffee in the lobby throughout the day. Please keep conversations to a minimum in here. We do want you to talk to each other. We do want you to network, obviously, but invite you to take those conversations to the lobby. And we will have dedicated networking breaks throughout the day. It's hard to believe we announced this event 5 weeks ago, and it's come together quite nicely. We were expecting about 250. Then registrations blew into over 300, so we might have about 300 people today, so we'll be standing room only. If you do see people standing around, I'd encourage you to shift to the center of your aisle, make it easier for them to get in. All right, well, 18 months ago, Bitcoin for Corporations was really just an idea. Our mission is to accelerate institutional Bitcoin adoption, and thanks to our growing network of over 40 member companies now, over 40 member companies now, we've really managed to do that. Our members include institutional service providers, Bitcoin treasury companies, capital allocators, banks, market makers, and the like. Roughly 7 out of every 10 Bitcoin held by public corporations now sits on the balance sheet of a BFC member. In the last 12 months, our members alone have added more than 8,500 Bitcoin to their balance sheets, which is roughly $1 billion. And again, obviously, current market conditions are top of mind for a lot of us in this room. Our research team, led by Allard Peng, just released a free research paper. If you scan this QR code, you will get access to the 32-page analysis of the quant framework for digital credit risk. So check that out. Lots of excitement in the air. New York is not only the financial capital of the world, but it's also, of course, hosting the FIFA World Cup. I guess you're not allowed to say FIFA World Cup, so I just wanted to make sure to say it out loud at least once. But hope you've been enjoying the tournament so far. Wanted to give a shout out to BitGo, our match day sponsor tomorrow. That event for the Panama and England game is also sold out. No, I cannot get you into the game. If you ask me or my team, you're gonna get the same answer, but we're excited for that. None of this happens without our partners, and our opening keynote today is from our presenting sponsor, one of the most respected commentators in this space. Here to kick off the afternoon, please welcome the head of Bitcoin strategy at Metaplanet, Dylan LeClair.
Check, check. Hello. Well, thank you for coming. Really appreciate everyone being here amidst the market turbulence. I have about a 10-slide deck today. I think we're going to keep it, pretty simple for some of the people in the room. We're going to go over, briefly the Bitcoin thesis, but in general, I want to zoom out, take a look at the market conditions. Everyone that's a Bitcoin holder, it obviously has been a tough 12 months. But the question I want to pose to everyone today is, has the thesis changed? What does the market look like? And where do we go from here? Okay, so I won't spend too much time on this slide. This is pretty basic, and I imagine 95% of the people in this room understand this. But if you don't, or you have more questions, or your conviction in this, in these fundamental principles is wavering, then happy to chat after the talk, but I won't spend too much time on it. So, I just kind of wanted to put some numbers to what we're seeing here. I almost titled the talk, Bitcoin is Dead, Long Live Bitcoin. I tweeted that about a week ago, and it led to some confusion among the Japanese audience. And so, I decided to, not go with that provocative title. But, to rewind, I guess, I work at Metaplanet. We're the third largest Bitcoin treasury company. We hold about 40,000 Bitcoin, so about 20 basis points of the Bitcoin network, give or take. And the journey started for us about 2 years ago, April of 2024, so a bit more than 2 years. And the company was just a small hotel company with a 14 million market cap. Today, despite the extreme volatility of Bitcoin and even more extreme volatility of the common stocks of companies holding Bitcoin, we're about a $1.8 billion company and change, and we have about $2.5 billion of Bitcoin. So it's really been a transformational 2 years for us, and I'll explain how we made that happen. So this chart, what are we looking at? This is the 200-week moving average for Bitcoin. So no fancy analytics here, simple moving average. Warren Buffett buys assets under the 200-week moving average. A lot of people, regardless of the asset class, will put something on their watch list. If it's under the 200-week moving average, it's maybe a decent time to start accumulating a position. And so the bottom here, this is the quantiles of the 200-week moving average and Bitcoin's price relative to it. Right? So we're in about the sixth percentile in all of Bitcoin's history relative to the 200-week. Could Bitcoin go lower? Absolutely. Who knows where the bottom is? But this is a bottom formation that's happening. Bitcoin's not going to die. If you think it is, well, maybe you're in the wrong room. But this is what the bottom looks like. I can tell you that sentiment in 2022 and all of the other bear markets felt just like this with a different flavor and different kind of talking points. So here's kind of another one of these charts, right? The magic of Bitcoin is we can see the supply with 100% transparency. And so it's like, how valuable would the data set be if you could see every gold bar in the entire world, when it changed hands, to who it changed hands to, at what price? It would be a $1 trillion data set. That'd be really extremely valuable to any capital allocator. With Bitcoin, we actually have the data, right? And so we can look at all of the coins in the network, when they last moved, when were they acquired, at what price. Is there some noise in that? Yeah, there is, right? If you change wallets or upgrade your cold storage, or an exchange shuffles some UTXOs around, it changes. But net, this is a pretty useful kind of signal of, okay, what's the aggregate market profile look like? You can kind of see the previous bear markets, right? So the current amount of the Bitcoin network that's in a loss is right now about equivalent to March of 2020 when we wicked to $3,000. Right? So Bitcoin's at 60K. The bears are ever confident. 50K, 40K, 30K, 20K, it's over, zero. But this is how it is every bear market. I think for those around in 2022, the calls were deafening for 12, 10, 8, 5, $3,000. We bottomed at 15, right? There was seemingly no catalyst for Bitcoin to ever go up again, and it did. And so we'll check out why. So again, this is kind of for people familiar with the on-chain world and this kind of emergent class of analytics. This is one of these really popular frameworks. It's called, this is a long-term holder supply. And how do you quantify a long-term holder? It's give or take, there's a statistical analysis component to this, but give or take, if a coin doesn't move for about 6 months, then we put them in the long-term holder bucket because the probability that those coins move is much, much less statistically than a coin that just moved 10 minutes ago. A coin that moved 10 minutes ago is very likely to move again. A coin that's been hodled for 6 months, 1 year, 2 years, 5 years is not likely to move. So right now, what do we see? We see about 82% of the network in long-term holder hands, right? And these are the people buying at 60 2 years ago, at 120 last year. These are everywhere in between. This is the amount of the network in the hands of really the believers. Maybe it's me and you, or maybe it's, maybe you're not a believer of Bitcoin, but the people buying this right now and holding it are the people that deeply, deeply believe in Bitcoin. So, an interesting pattern has emerged here, right? In a bull market, what you often hear, especially on X and Twitter with all the noise, is supply squeeze. Supply squeeze. Bitcoin's going up. Why? It's a scarce asset, more demand than supply. It's a supply squeeze. But actually, that's a little bit of an inverted truth. In a bull market, you can see that there's actually a distribution, right? So the people that were stacking Bitcoin at $3,000, at $15,000, they take a little slice off at the top, right? What's happening now? It's the opposite. So right now, actually, you hear it's deafening at the peaks. Right now, there's no reason for Bitcoin to ever go up again. But what do we have forming? A supply squeeze, right? And so eventually, all of the willing sellers, all of the forced sellers, all of the people that are saying, okay, it's over forever, just take their ball and go home, right? They sold. And who's buying? It's the convicted long-term holders, right? And so eventually, just like you saw in 2022, through the depths of the bear, what do you see? Relentless accumulation, right? And then into the bull, there's a bit of a distribution. This is how Bitcoin's maturing, and it does it in these big, long 3 to 4 year macro cycles. So there's a lot of noise in between. But fundamentally, why will Bitcoin ever go up again? Well, the ETFs are selling, and Saylor's going to get liquidated, and Quantum's going to send Bitcoin to zero, and there's all these different narratives going on, and it's deafening, right? There's no reason for Bitcoin to ever go up again. This is the reason. It's just a fundamental supply-demand imbalance, and every day it's building. So with that said, I kind of set the stage on kind of big picture views. I wanted to talk a little bit about Metaplanet. We are a Bitcoin Treasury company, but I think people think we are only a Bitcoin Treasury company. We're only a box of Bitcoin. And frankly, I don't think there's anything wrong with that, because I'm extremely bullish the underlying asset. So I'm happy to be sitting on a huge pile of Bitcoin. But Metaplanet is more than that, and I would like to share with you why. So as of the current last quarter, Metaplanet has 250,000 retail shareholders in Japan. So that's about 1 out of every 600 people in the entire country, men, woman, child, elderly, is a shareholder of our company. And to be transparent and frank with you, and I'm sure many of you know, the Bitcoin and our common stock from June of 2025 has been in a pretty tough downtrend, right? In the face of that, what's happening? Bitcoin adoption through Metaplanet is soaring. Why? Well, Japan's a bit interesting. It's a conservative culture. Mt. Gox happened, and it was sort of this like corporate culture shock, PTSD, right? And so Bitcoin and the crypto digital asset space more broadly was sort of viewed for a long, long time as untouchable, right? And Metaplanet came in 2024 and really broke that taboo. And it's one of the things that the individual, the retail shareholders, for the first time, had a way to express their view of the world in something that was familiar, right? And so, not to get too much in the weeds, but everybody in Japan has a securities account. If you want to log into a crypto exchange and buy Bitcoin, never mind all the tax considerations, there's physical paperwork, it takes weeks, the bid-ask spreads are very wide. There's not nearly the amount of adoption for crypto digital asset native onboarding versus brokerage account financial securities, right? And so why are we seeing this? I mean, frankly, the exchanges in Japan, the Bitcoin trading volume, really dried up at the same time that Metaplanet exploded, right? And so people, for the first time, had a way to express their view of the world in something they're already familiar with, a brokerage account. So what's next for Metaplanet? Why are we not just a big bag of Bitcoin? That's what the skeptics say, is we're just a holding company that does nothing else. Well, what's the grand vision for us? How can we capitalize on this dynamic? 250,000 retail shareholders and growing. And to put it in context, it's one of the top 30, 40 companies in all of Japan, right? And so there's a real movement, there's a real magic in the air, despite the drawdown. And I think you saw this in a similar way in kind of the previous cycle in 2022 with MicroStrategy, right? It was only the believers left. It was only the believers in Bitcoin, the fundamental hodlers and drivers of this adoption curve were the only ones left at the end of the ghastly bear market. So what's next for Metaplanet? Well, our vision is really to be a full stack financial platform globally, but based in Japan. And so, we have a huge collateral base, but there's so much more to do. And so we're really, really focused on how do we make Bitcoin as a collateral foundation for equity, for credit, for debt. It could be through a perpetual preferred, but it also could be through private notes, Bitcoin-backed lending, various structured products, other securities. The reality is a lot of the world can't handle, touch, interact with native spot commodity Bitcoin. And I want to preface that by saying everybody should buy Bitcoin and send it to cold storage, and there's nothing that can replicate that self-sovereignty. But if you talk to Capital Group or if you talk to trillion-dollar asset managers, they cannot buy spot Bitcoin in cold storage and send it to their ledger. It's just the reality. So, there's 95% of the capital in the world can't actually interact with a commodity. They need a security, they need something that they know and that has the regulatory backdrop behind it. So what does Metaplanet do? About a week ago, we acquired Cboe Securities. It's a small online digital native bond brokerage firm in Japan with a Type 1 license. So upon closing, that will be renamed to Metaplanet Securities. And the vision is to onboard our retail audience into a full stack Bitcoin native financial platform. Not crypto, but Bitcoin focused, Bitcoin at the core. And so the securities is just one piece of the puzzle for us. I mean, really, we see the Treasury driving the value of the company, but synergistically, securities, asset management, lending, these are all things that we're studying and working on intensely. And so what's the total addressable market for us, or not even for Metaplanet, but for Bitcoin in general in the capital markets? And Japan is particularly relevant because there's a huge fixed income market, there's a huge amount of cash savings earning nothing, right? And so just to give some context, the junk bond market in Japan does not exist, right? And so when we're looking at junk fixed income paper to try to study what could be possible, there literally isn't one. 6% fixed income in Japan is like the junkiest junk bond you could possibly ever dream of. And so there's a gap in this market, and we think we have a way to fulfill some of that demand. And so, I think just to kind of step back a little, right now Bitcoin sentiment is totally in the gutter. We are deeply convicted, and we are rallying over in the East hundreds of thousands of diehard believers of Bitcoin through Metaplanet. And our goal is to onboard all of Japan, as many as we can, into the asset and build a foundation on Bitcoin for the long term. And so in due course, we will find a bottom. Bitcoin will do what it always does and rip the faces off all of the bears. And at that point in time, when Bitcoin doesn't die for the 15th time in a row, we will be positioned. Our goal is to be a full stack financial platform domiciled in Japan, operating at a global scale. And our goal on a long time frame is to accumulate 1% of the network. And so we have some work to do. We have our work cut out for us, but we think Japan is a really unique market, and we think we have a quasi-monopoly in that market. And so I think that is, so this is just our shareholder meeting about a year ago. And so this is on a Monday morning. For context, this is an extraordinary general meeting. So you have annual meetings for shareholders. You have extraordinary meetings when you need to amend the articles of incorporation or authorize new classes of shares, et cetera. This is an extraordinary general meeting. And so for people that, we have a lot of TradFi members of our team that have been in the capital markets in Japan for a long, long time. This doesn't happen for any company, even the mega caps. And so there's something in the air here, and I think we've really, we've caught lightning in a bottle with the captive, latent, Bitcoin native energy. So with all that said, I think I'm gonna wrap it up. I apologize for jumping around a little bit, but thank you for all being here. It really means a lot. Thank you for the BFC team, and thanks for tuning in.
Perfect way to frame the rest of the afternoon. And stick around. Dylan's actually going to be back with us. He'll be bookending the day with a conversation later with Mike Belshi, CEO of BitGo. We're going to keep rolling here with our next session. So as the stage gets reset, I want to make sure all our panelists are here. Ready? All right, we found them. Cool. All right, so we are going to unpack the nuances of underwriting digital credit. So moderating our first panel, please help me welcome to the stage from True North, Dan Hillery.
Welcome, everyone. I'm Dan Hillery, and I'm here with three wonderful gentlemen. I'll let them introduce themselves. And we're going to get into digital credit, the recent volatility, kind of talk about what the next steps in the future of the entire market is. So I'm super excited. Thanks for joining us.
Yeah, I'm Jeff Walton, Chief Risk Officer at Strive. We've got a digital credit instrument in the market, SATA, and yeah, excited to talk about recent volatility.
Hey everyone, Tyler Evans, great to be here. I am the Chief Investment Officer at UTXO Management, as well as our parent company, Nakamoto.
Hello everyone, Alexandre, Board Director of Bitcoin Strategy at Capital B, Europe's first and largest Bitcoin Treasury company. We've been the largest issuer of Bitcoin-backed credit over in Europe in a non-listed format, and we are focused on the potential of perpetual digital credit for the future.
Amazing. Thank you, guys. So I'll start off with a question for Jeff and then open it to the panel. So obviously, Strive was really the first issuer to have a cash reserve backing the preferred equity dividends, right, plus the Bitcoin on the balance sheet and the good faith of the issuer. What were those conversations like, and kind of what intel can you give us from institutions as to what they're looking for in these digital credit products?
Good question. Yeah, we were the first issuer to have a cash reserve. When we were going to market, because we were a small Bitcoin treasury company and we didn't have a 800,000 Bitcoin like Strategy did, we had to have a few more investor protections in place in order to instill confidence in going out to market with a product. So we had the cash reserve, and the idea was the cash reserve is effectively first line of defense for paying the dividend in the future if we're unable to raise equity capital or generate yield on top of the Bitcoin. So, and that thought process has evolved a little bit as we're managing our balance sheet to understanding that there's volatility in the underlying Bitcoin. We want to generate and create a good credit to the market that there's confidence that we're going to have the ability to pay that dividend into perpetuity. That's the entire concept. So as many have seen, as we have evolved and issued more SATA into the market, we have been growing that cash reserve in lockstep with the growth of the underlying instrument, as we're trying to emphasize to the market that we are here to withstand market shocks and market volatility. I would say what we're experiencing right now is kind of like a financial earthquake. And this capital structure is designed to withstand and be standing after the earthquake is over. So that's kind of how we view it, that cash buffer is the first line of defense. We also hold STRC on our balance sheet as a moderate duration instrument, understanding that we are holding this for a long duration.
Okay, amazing. I really like that perspective, and I think it's really unique that you guys pioneered this sort of duration matched liabilities curve on your own balance sheet. So Tyler, when you're making investment decisions and talking to institutional allocators, what are they saying to you? Do they value the cash? Do they value the Bitcoin? Do they value the liquidity and the equity? What are they saying they need from a preferred equity issuer to be comfortable in that instrument? And then furthermore, I know recently Strategy made some management decisions around the way they're managing their cash reserve. It was cut in half to pay a convertible dividend or a convertible obligation. And this was credit positive, but it seemed that the market was a little bit wary of that decision, and there's been massive volatility and stretch. What are the things you're hearing about this sort of decision making, and what would you advise a company to do with regards to the cash management?
Well, I got to give hats off to Strive for kind of pioneering this concept. And when we're talking to traditional fixed income investors, they're used to underwriting credit risk based on cash flows. And so I think in a model where you have these digital credit issuers that have a strong cash flow engine, where they're able to pay the dividends from operating income every single month, I think that model is easy to underwrite and understand. When it's purely asset backed or a balance sheet type calculus, what the cash reserve really does is it gives optionality to the issuer and prevents that volatility. And I think that's honestly what we're seeing in the market this week is kind of a liquidity crunch and a crisis of confidence around these products, due in part to the perceived weakness of the cash reserve behind Stretch today. Having used that to buy back the convertibles, which should be in the abstract without feeling the day-to-day volatility of the market. That should be a very positive thing for stretch holders. You're retiring a senior liability ahead of the stretch holders at a discount. That should be a credit positive event, as you mentioned, Dan. But that's a trade-off for less liquidity in the meantime, and that kind of a liquidity crunch is what has spooked the market so much today.
I just want to add on top of that, I think what we've seen is there was some loss of confidence in the underlying instrument, and that resulted in what we saw, a leverage liquidation. And we've been running around New York here the last week, getting an understanding of what's happening in the market, and there was a significant amount of leverage on top of the instrument. Why was there leverage on top of the instrument? Because the creation of these credit instruments established a high yield, high liquidity, stable security. And that bred a landscape for interest in leverage. So as there was weakness in the security and the leverage effectively got liquidated, and there was pressure, additional sell pressure from the leverage that was in the market.
Okay, those are great answers. So Alexandre, now to you. I know you've had the benefit now of watching both Strategy and Strive IPO their own digital credit preferred equity instruments, and you've been a large issuer of private credit, right? Private credit in your market. What are your thoughts now, seeing all of this volatility and how these two companies are managing their cash with the creation of a preferred security? What are you thinking about? What decisions are you going to make? How are you viewing the differences in their prospectuses and taking that into account for your own instrument?
Sure. Our objective is to become and consolidate our leadership as a digital credit issuer in Europe. The first step for us has been the non-listed Bitcoin-backed credit products, and our conviction is that the current market is separating the market operators with conviction, with discipline, from market operators that can have doubt or do not understand the structural aspect of the market. The context today is that the screens are red, that the market has been hammered, minus 50%. From a traditional perspective, this is big. From a Bitcoin perspective, this is just volatility one. Bitcoin historically has been going through those minus 70, 80, 60% drawdowns, and Strategy, Strive, Capital B, we are all being built, and Nakamoto, we are all being built for those structures of market. And when I think it's a good moment to remember why we are here. We are here because Bitcoin has 21 million units. There is an infinite monetary supply, and it's not stopping anytime soon. In fact, when you look in the past, any periods of oil supply shocks or internet bubbles or great financial crisis have all been followed by 250 to 500% monetary increases in the next 10 to 15 years. And the result of this is that Bitcoin is growing at 30 to 60% CAGR over periods of 5 to 10 years. And the ability to be financed at 11, 13% is a major arbitrage. And before, when we were in the 2022 bear market, there was no digital credit industry. There was not perpetual digital credit instrument. The ability to align the maturity of the financing instrument with the objective of holding of the asset, the perpetual objective. This is something we have now. Back in 2022, Strategy were in a point where there was more debt than assets, but now it's 50% overall leverage, even a bit less. And I think we are in a much more robust situation than where we were 2022, and that we will be in a much better position 4 years from now. But it's just the ability to zoom out and to see what the companies are building. And for Capital B, today we've been sometimes called very conservative. We have no fiat debt on the balance sheet with our Bitcoin strategy. And digital credit for us is the biggest opportunity we see. All I see is opportunity in the market, and the Bitcoin convicted investors also see of big opportunities. The first time for a long time that I've seen even traditional finance people interested in Bitcoin come to me and say, oh, I bought Stretch for the first time, or I bought SATA for the first time, because it's just mispricing of the Bitcoin future.
Okay, yeah, that's a great perspective. Thank you, Alexander. So my next question for, I think, Jeff, and then opening it up is, you know, obviously last month Strategy inoculated the market, those are Saylor's words, with a 32 Bitcoin sale. This represented about $2 million of value. Obviously, this was not enough to move the market in any material way, but there was clearly some animal spirits in the price of Bitcoin as they were selling these coins. So what are your thoughts, specifically Tyler and Jeff, around selling Bitcoin to pay dividends at a discount to NAV when it comes to your common equity versus selling common equity at a discount or at a premium? Obviously, there's all sorts of permutations here, but generally, what's your broad sort of principle at Strive, and then for how you value these companies when it comes to selling the assets on the balance sheet to either pay dividends or potentially buy back securities trading at a discount, and versus selling common equity?
Sure. Well, you know, I think that's what the market is waiting to see this week, is how the issuers are going to respond to this liquidity crunch, and what measures they can take to intervene in the market, or if they'll just, you know, let the market freely price these things. You know, our team has kind of debated this endlessly in terms of what are the best paths forward for the large issuers especially. And I think inoculating the market further by selling a couple years worth of dividends and having a really strong cash liquidity position, that's a one-time event where you can say we're in a strong financial position and we don't expect to sell any Bitcoin in the near term. I think that would be an effective thing to help restore confidence. But on the other hand, and I think this is an unpopular opinion, as I've shared it a little bit, but if you look at the reason why Strategy and now Strive chose to finance themselves with preferred equity rather than a typical credit fixed income product, is it gives them the ability as an issuer to have that flexibility in terms of no repayment cliff, and the ability to pause the dividends without triggering a default. And the reason they built those into those products is exactly for this type of scenario, to prevent an issuer from having to become a forced seller of Bitcoin at a point of weakness in the market. And so in my mind, that would actually be kind of the strongest message. I think it would be a very painful one in the short term for the market to digest. But if you know, Saylor came to us on Monday morning and said, we're going to pause the Stretch dividend, but everything's going to be fine, and the price of it will float freely, and 3 months later or 2 months later, he turns back on the dividend, he's inoculated the market once again that the design of the product worked as intended and prevented him from becoming a forced seller of Bitcoin at the lows of the year. So I'm really interested to see what path issuers choose here.
I think that would be a bad idea to pause the dividend. I think operating in the credit markets is incredibly important. Trust is what you're selling, and trust that you're going to continue to pay the dividend is the primary thing that I think the market is hanging on here. I mean, there's a significant amount of liquidity behind the balance sheet. It's cash, it's Bitcoin. I think the reality here is that Bitcoin is incredibly liquid. It trades 20 million to sometimes 20 billion to sometimes $60 billion of liquidity a day, and there's significant optionality when looking at the balance sheet as a whole. To answer your question specifically, this is a multivariate calculus that is constantly being monitored behind the scenes by both issuer Strategy and Strive. And we're looking at not just the Bitcoin and the common, but the Bitcoin and the common and the credit instrument, and the relativity of all three of them, and a combined transaction of looking at a quarter by quarter basis or a long-term basis. Again, with the goal here being that we are long-term net accumulators of the underlying Bitcoin. We want to express a very long and amplified position on the underlying Bitcoin. And I think that's what investors both on the common stock expect, and it's what investors on the credit instrument also expect. Obviously, we have the ability to sell the Bitcoin if we needed to pay the dividend obligation. For us at Strive, our daily dividend obligation is around $400,000. Our common stock trades, over the last 30 days, it's averaged about $60 million a day. And for a company like Strategy, their daily obligation is around $7 million. Just yesterday, the common stock traded $4 billion. So that relativity is very small, and I think that capital making decision is a complex one, and it needs to be thought about on a long-term basis, quarterly, and an annual basis.
The other thing I'd really like to see the issuers maybe reconsider here, and I made this point on a podcast this week, but with the design of these products, with the peg that issuers are trying to enforce at $100, with the constant ATM sell pressure, you're creating this convexity that only exists to the downside with this implicit backstop at $100. And so, in between dividend periods, which Strive has thankfully solved, there's almost like a risk-free short trade that you could put on in the market where the price isn't going to run away from you. And so if the issuers chose to broaden those trading bands or those trading ranges or be less aggressive on the issuance schedule via the ATM, and you let these products trade up in times of high demand, and I think we would have, without an ATM program active, we would have seen Stretch and SATA both trading significantly above the $100 par value over the last couple months. If you have that natural market force where you enforce a wider band or you let there be some volatility both to the upside and the downside rather than only to the downside, I think that would change the perception of these products and remove some of the attack surface, if you will, for people who want to bet against them.
Well said. I think that's an important consideration. We have just 5 minutes left, so I want to get into kind of what I believe to be the next chapter in digital credit, and I'll like to first hear from Alexandre, and then we'll do kind of a speed round across the panel. But Jeff, you used to work in reinsurance, and we talk a lot on True North about structuring these digital credit products, right? How do you structure these into packages, into funds that are attractive to institutional allocators, to fixed income allocators? Even just as simple as preferred equity is not credit, and so we're unable to make Stretch and SATA fit into the credit bucket for an allocator, right? That's a very baseline problem the industry has right now. So what are your thoughts moving forward about structure, and how can we bring that to these types of products? First, you, Alexandre, maybe give us a quick, brief insight into the private version which you've created.
Yeah, I think at the end of the day, a Bitcoin treasury company is in the business of consistency. And I think the turbulence we are seeing in the market is just because of the discovery of what the market values the most and what the market expects from the companies. One key thing is definitely the consistency. Another thing is it seems like a 2-year cash reserve is very appreciated by the market, and this is just because typical bear markets last about 1.5 years to 2 years. That's quite simple. The risk is very simple. It's Bitcoin going to zero or Bitcoin going minus 80% for 10 years. And this is the risk. And if you are not able to see and price and appreciate that risk, then this will be definitely too risky. But this is the risk. You can allocate the percentage, but then it comes to the structuration. And the structuration from a private market lens, what we've done is Bitcoin-denominated convertible notes over 5 years, 0% coupon, no liquidation risk. And so if Bitcoin goes to zero, we give back Bitcoin at zero. And if Bitcoin goes up, there is a conversion, and it's a major call option. On the digital credit side, I think the key aspects is that the market is realizing that yes, it's about the ability to raise rates, but it's also about the ability to have a structure overall, and I think Strive has been extremely good at that, with the preferred being at the top of the balance sheet structure and effectively be the highest senior claim on the company. And these characteristics in terms of the structure, I think, will be more and more key for the appreciation of the credit risk.
Absolutely. Tyler?
Yeah, in terms of structure, this is something our team at UTXO Management has been working a lot on over the past couple months, and we see these digital credit instruments as being really versatile building blocks in a portfolio to be able to build new securities around. And one of those things that you mentioned, Dan, is being able to transform these from perpetual preferred equities into a true credit allocator's box, which means having a duration on them, which means having a covered loss ratio. And one of the things we announced at Bitcoin Vegas a couple months ago is a new fund that we are soon launching that takes like a CLO or CDO structure for these digital credit instruments, where we can borrow some of Wall Street's playbook in terms of tranching out the risk return into different levels, where there's senior, junior, mezzanine, where we can build different risk return profiles and be able to remove some of the volatility from these products in a way that maybe an issuer doesn't have the tools to today, to make them more suitable for new types of investors. And so I think we'll see a lot of experimentation on that front going forward, and a lot of lessons learned from the volatility the space is going through this week. And I'm optimistic for the solutions we can come out of this with.
Get it done. So there's a ton of opportunity here. Strive, we're a structured finance company. You take Bitcoin at perpetual. We've created a perpetual preferred equity and our common equity. Both are perpetuals. You could take that perpetual preferred equity and you could tranche it again into a term instrument, a senior term instrument, and put that into a special purpose vehicle that has, as Tyler mentioned, different risk return metrics. Now, this solves a couple problems. The main agency can get more comfortable with that. And that gives you access to insurance companies, pension funds, and anybody that needs a rating on an instrument. But that also solves a leverage element, because right now there's a leverage duration mismatch on digital credit, and we've seen it this week. When you have short-term leverage on a margin on a digital credit instrument, if there's volatility, you have to liquidate. Now, if we can create a structural leverage equity style component, that actually solves the structural leverage duration match of the instruments too.
Awesome. Well, our time's up, guys. This has been an awesome conversation. Thank you, everyone, for listening, and talk soon.
All right. Thank you, guys. Let's give it up one more time for our panel. Yo, where's the... thank you. There we go. All right. We're going to keep the conversations rolling here. As we know, digital credit is just one element of what we're talking about when we talk about institutional adoption. But once you have Bitcoin on the balance sheet, how do you maximize it? Here to host our next conversation is Joshua Lim from FalconX, and he will introduce our panel. Joshua?
All right, welcome everyone. Thanks for joining us for this panel on maximizing Bitcoin on the balance sheet. My biggest regret here is that I don't have an orange tie for these types of events, but I'll make sure to get one for the next one. So we're here to talk about a fundamental evolution in the way corporations view Bitcoin and digital assets generally. For many years, holding Bitcoin on your treasury was pretty one-dimensional, right? It was buying and holding, it was hodling, it was stacking sats, right? And nowadays, it's much more beyond just that passive accumulation strategy. And the biggest part that people want to see and public shareholders want to see is some kind of differentiation and some kind of thoughtful approach to generating yield and maximizing that value on the balance sheet. So CFOs and treasurers generally are thinking about things like how to approach volatility in the markets, right? Making sure that you don't have to sell at an inopportune time, as well as sort of flexibility in liquidity, right? Basically getting cash out of the assets that are on the balance sheet. So we have 3 panelists here today who are really experts in this category, and I'd like all of you guys to introduce yourselves.
Hey everyone, my name is Himanshu Sahai. I'm the co-founder of Arch Lending. Arch is primarily a Bitcoin-backed lender in the US. We're fully regulated here. And we work with a number of treasuries already where we offer them vanilla over-collateralized loans as well as structured products. And we'll go into that today.
My name is Hunter Albright. I'm the Chief Revenue Officer of Salt Lending. We've been a Bitcoin credit partner since 2016, helping provide both liquidity and yield opportunities for companies that hold Bitcoin on the balance sheet.
Hi, I'm Jay Pollack, and I'm head of strategy for the Verified X network. We're a layer 1 that's been building for 6 years, helping bring Bitcoin natively into the ecosystem and activating it into programmable financial capital.
Great. Yeah, so I think the core thesis of this panel is going to be around how to generate value from Bitcoin on the balance sheet without exposing yourself to some kind of existential risk, right? And the main sources of risk historically have been sort of smart contract, bridging risk, deploying assets on chain, as well as the sort of rehypothecation risk that a lot of firms encountered last cycle with sort of the lending chains that existed in the market structure. So maybe just to start with Hunter, thinking about CFOs and how they approach drawdowns, right? Obviously, CFOs are very risk averse, but they still want to access working capital, and they want to avoid triggering capital gains. They want to avoid, having an event where they have to sell the Bitcoin at the lows. So what is the best way for them to think about modeling kind of the volatility risk, what LTV ratios and things like that? And I know that your company is focused on advising and helping firms access that working capital. So,
yeah, I mean, I think the first thing I'd touch on is really for all of us in the ecosystem, it's important to build the utility of Bitcoin to help attract more capital into the ecosystem. And so I think providers of, all sort of across the spectrum are important. And I was giving a talk in the UK recently and did a little bit of research, and I think it just exemplifies some of the power that I think Bitcoin can have, even at a suppressed price. And that pre-pandemic in the UK, businesses, small businesses and medium-sized, were getting approved for loans at around a 70 to 80% rate. Post-pandemic, it's now down to a 30 to 40% rate. So as a business, if you can't even get capital off your revenues, off the strength of your business, how are you going to be resilient? How are you going to grow? And I think Bitcoin on the balance sheet creates that opportunity as an asset class that provides greater flexibility. And so at Salt, we lend against it and do help sort of, provide advice in a credit partnership to how to think about it. So it can be a yield generator, it can be a liquidity provider. And then Joshua, to get back to your question, in terms of how do you think about protecting it, I think about it as a framework. I think LTV is your friend, and so you can start at a lower LTV, get comfortable with it, understand how it behaves, how you would manage it. Second tier for me is really what are your reserves? What are the other assets you could bring to bear to sort of protect your position, and how would you manage it? And that would go along with a proactive strategy about when you would do that and how much you would do. And the third is what are you looking for in terms of terms and conditions related to the loan agreement, because I think lenders like Arch and Salt and others have very different terms than what are on chain. Many of them are very advantageous, no rehypothecation, very clear in terms of what they're going to do with the collateral, and then also look for other downside protection. How can you take some of the risk out of the volatility of the loan that you might have?
That's great. And Himanshu, at Arch Lending, we know that you have a sensitivity to kind of rehypothecation. And you've taken a different approach to a lot of lenders in the previous cycle, which relied very heavily on rehypothecation. How do you think about the product set that you offer companies in the space?
For sure. I think rehypothecation as a concept really died out after the last cycle, and most lenders today are very comfortable going out to market with non-rehypothecating products. Really, the risk is the counterparty risk there. If you are rehypothecating and you have counterparty risk or duration risk in the Bitcoin that's being lent out or being used to generate yield, when your borrower wants to get the loan done, they want to prepay it or they want to close it out, that Bitcoin may not be there. And I'm not even going to speak about the counterparty risk that introduces, that's introduced by introducing the concept. So we've taken a staunch approach to not do it. However, I think there are opportunities now with structured products, with options, to introduce some of the benefits of what people would perceive from rehypothecation, which is frankly a lower rate. We've done that. So we have structured products that we work with different treasuries on, where you can do either a collar or a put protected option or a yield enhancement, which does kind of mimic those structures, but doesn't introduce external counterparty risk and protects you as a borrower, where you don't have liquidation, you don't have margin calls, and your rate gets significantly discounted as a result. I think back then, when people were lending out at 14, 15%, rehypothecation was attractive. I think today, if you're a treasury borrowing, you're going to be in the single digits, and you're going to be quite comfortable with the rate. So even with no rehypothecation, there's a very attractive rate to be had. But if you do want some structured products, we can have a discussion on what that means to you, how involved do you want to be, are you a financial end user or not, and then we can see how that goes moving forward.
Hunter, do you have anything to add?
No, I think the fact that there's a lot more traditional capital understanding Bitcoin as an asset class, as Himanshu said, the rates are coming down, and I think that's going to allow lenders to provide more options and innovative products, one, that are both simpler, and two, provide, solve the problems that businesses have.
Yeah, I think one big difference between that, the last cycle and now is how capital markets have evolved. In the past, it was retail capital from deposits being lent out, all duration mismatched, and if you had a bank run situation, you'd be in big trouble. Today, there's a number of different structures. Most lenders today have capital facilities at scale. We did our first tokenized CLO earlier this year, which basically was an on-chain securitization of a facility. And I think like we've seen other lenders do that as well, where we actually have duration matched capital at scale at decent rates and accessing traditional finance to fund those facilities, which lets us grow in a much more sustainable manner.
I want to touch a little bit on structured products just generally in crypto. So there have been a number of notable launches. I think BlackRock just announced a new ETF that is effectively a Bitcoin overriding strategy. Neos has had one in the market for at least I think a year, with about $1 billion in assets. There is a big focus on using derivatives and options to generate yield. Can you guys talk a little bit about what you're seeing in the market there?
Sure. I think from a lending perspective, and you know this because we work with you on this, the idea really is that you want to reduce risk and you want to increase the yield on the Bitcoin that's there, so that you have a rate that's attractive enough for you to go deploy into something else and be accretive from that use case. So what we offer is collars, where you can have a put and a call that's sold at a premium, and as long as Bitcoin stays in that range, you don't have margin call risk or liquidation risk, and the option premiums actually pay down the interest rate, so it's quite attractive from that perspective. Now, the other side of that is just placing one side of that trade, where you either have a put or a call, and if you have just a put, it protects you from liquidations. It does come at a slight premium. If you have a call, that enhances the yield and gives you a bit of a benefit. Now, I know there's a number of other structures as well. There's covered call strategies that people apply. I know Bitwise just did something with Nakamoto, where they're doing a covered call strategy on their Bitcoin. I think our goal as lenders and people providing services to Bitcoin treasuries should be to give them a menu of options and let them kind of choose based on their risk parameters and their goals. A bigger balance sheet may have a smaller hurdle rate that they're targeting versus a smaller balance sheet that's looking to grow. Like, for example, we have a product called the Bitcoin Accumulator, which is a structured product to help grow the balance sheet for treasuries. So there's different use cases, and I'm sure you have some stuff you want to talk about there too.
Yeah, I mean, I guess the thing I would say is it's exciting to see different products come out, both from ETFs, what Strive and Strategy are doing, But at the end of the day, I think if you own spot, and the more we can do to encourage individuals and companies to own spot, you get additional capabilities that go along with it and how you can leverage it in terms of speed of action. And I think it's important to continue to build the plumbing. We were talking a little bit before we came on about how do we enable that, because then collectively, again, going back to we've all got to build more value to bring more capital into the space and show that you can use it for your advantage, whether it's liquidity, whether it is yield, but really help businesses be more resilient and more stable. Because I think if we think in the age of AI, that we're going to have a lot more smaller and medium-sized businesses that are going to need these financial tools, and they can be less sophisticated and simpler, or they can be more sophisticated depending on the knowledge and the appetite, but it's important to build the menu.
That's great. And switching gears a little bit to the more technological aspect of things, Jay, do you want to talk a little bit about what you're doing at VerifiedX? You know, in particular, avoiding some of the kind of smart contract risk that's kind of inherent in deploying Bitcoin on chain to generate yield.
Yeah, no, thanks for the question. So let's put tech aside for a second. You know, I think that to date we've been largely faced with the issue of, you know, choosing between utility and security, and we don't have to make that trade-off anymore, right? You know, we've done a really great job as an industry of financializing Bitcoin. What we haven't done as good of a job of is creating utility with it, right? So I think from our standpoint, our thesis is let's bring Bitcoin into the at the protocol level. Let's activate a consensus with features where we can reduce rehypothecation, we can, you know, reduce counterparty risk, bridges smart contract vulnerabilities, perfect the underlying rights of ownership, and maintain native redemption liquidity, right? I don't think institutions wake up every day thinking about how do I squeeze an extra 2% out of my Bitcoin. I think what they do is they wake up every day saying, how can I make my Bitcoin more productive while preserving the underlying properties as to why I bought it in the first place. So, you know, for us, it's the first iteration of acquiring Bitcoin. The second iteration was how do I custody Bitcoin? The next iteration, in our opinion, is how do I turn Bitcoin into programmable financial infrastructure?
That's great. And you guys recently launched sort of like a privacy layer around moving your VBTC product. Can you talk a little bit about that? Like, that is obviously an important feature of most institutional markets where there is a customer confidentiality and privacy around transactions. How have you guys been building around that?
Yeah, so it's really interesting. Privacy is a narrative that we're hearing a lot about today in the marketplace. You know, it's a little controversial at times. You know, how do you effectuate a privacy transaction but maintain compliance at the same time, right? You know, I think that confidentiality is a business requirement and compliance is a regulatory requirement. So for us, we embedded in our consensus a Planck-based system with zero-knowledge proofs, with Merkle notes, but you know, all that technical jargon aside, what happens is you have viewing keys and whitelisting that allow you to share that with the appropriate counterparties for a purview of transaction history and real-time auditability, right? So I think that we're living in a world now where privacy is certainly important in order to shield treasury management movements and trading strategies to maintain that competitive edge, but also at the same time to maintain a level of compliance. So, you know, I think confidentiality and privacy, compliance, excuse me, can coexist at the same time, for sure.
Thanks. We live in a world where AI is kind of top of everyone's minds these days, and you know, obviously, institutional grade service providers like yourselves, right, have a lot of sophistication around risk management, compliance, collateral management, and things like that. Can you talk about how some of the tooling around these things has evolved inside your companies when you're dealing with these Bitcoin-backed loans?
Sure. I think we made a conscious decision to build our platform from a technology-first fashion, not an operational-first fashion. So we have thousands of clients that we serve, but it doesn't require a human in the loop at any point in the system. So it's everything from onboarding, KYC, KYB, trust onboarding, whatever, all the way up to margin calls, liquidations. It's fully automated, which lets us, with a very small team, serve a large number of clients, whether you're borrowing $5,000 as retail or $50 million as an institution. And it just goes to say that I think a lot of lenders in the past, and maybe some today as well that are more on the institutional side, do serve a large number of clients, but it's very operationally heavy. So we made that decision, it's helped us grow. We built our own ledgering, which really was a conscious decision that let us do different kinds of loans. I think if you build on top of someone else's ledger, which a lot of companies do, it restricts you to the suite of offerings that they have. We have now 7 different loan offerings, which work because we have our own ledger. And I think that's been a very good decision that we made. Moving forward, we're going to plug into more venues for trading, obviously. We already do that with some, but we'll continue to do it further. And as we offer new products around yield and stuff, we'll have more integrations there. But everything always is technology first, with a human element that adds to the comfort and gives you a client representative that's always there for you. But it's a system that rules it all.
I don't think this industry has a problem being technology first. I think, it's all nothing existed when we started, and so have built a very sort of customer-centric platform to really enable the technology. I think it's one of the things that the companies are doing well and why the public markets are interested in funding the loans, because of the technology that allows the liquidation and the management of the loans at a very essentially risk-free manner. I think the utility of interoperability is exciting in terms of a little bit what Jay was saying about sort of custody at different partners, where we have a lending as a service offering that we're working with people so custody can stay on different platforms, service the customers there, have the level of privacy, have the level of protection, but help the utility, people get more utility out of the Bitcoin without having to move in. And I think we'll see more of that happening as both the market grows geographically as well as in size.
Any thoughts, Jay?
Yeah, I think I agree completely. And I think that, by doing so, we're going to help be additive and even help restore, the true scarcity properties of Bitcoin. And largely on-chain price discovery.
All right. Maybe more of a quick one for all of you. What is the single biggest kind of operational or structural bottleneck for companies who want to switch from a passive, cold storage strategy to something more active?
Well, I think it's education. The first step, I think at least I can speak to both of our companies, we require assets in qualified custody. And in the past, you often had cold storage or you often had a non-custodial setup because you could access DeFi rails with it. You can do that now with a qualified custody offering, whether it's BitGo or Anchorage or some of the other custodians out there. So we can bring the level of safety, the bankruptcy remote treatment, the insurance that you get from qualified custody into your operational flows today, and then you can access platforms like ours, you can access DeFi if you want to, and you can access different structures while keeping your Bitcoin safe in custody. And I think that's a new, avenue that wasn't quite there in the past. I find that most treasuries starting today do hold qualified custody, so I don't think that's really a bottleneck, at least not one that I've experienced. But really it's the education. I think most treasuries don't know what they can do. The whole treasury market is very new, right? Outside of the few big ones, most of them are very new. They've launched in the past year. They've just gotten past the first era of buying the Bitcoin that they have, and now they're trying to find the utility. So I think the biggest bottleneck really is education, and I spend all my time educating people on what you can do with it, giving them the options, and once they have the options, they can make an educated guess or an educated decision of what makes sense for their business and for their goals.
I mean, I would amplify the education and also helping people understand the benefits of the strategy, right? We're in a world where both as an individuals and businesses, the tactics of being capital efficient, being tax efficient, and operating with speed, in terms of the asset is unprecedented in terms of what larger companies and high net worth individuals has been doing for centuries. And I think you just have to get out there and try it. And I would argue that at a depressed price, now's a great time to sort of experiment and learn. But that's the big thing. I do a lot of work with small and medium-sized businesses from a sort of education and teaching perspective. And you know, they are experts on what they're operating in, not experts on the balance sheet. And so there's a simplification and ease of onboarding that will be required to help them understand how to take advantage of it more. And I think that will be a real enabler, especially as all the plumbing and the piping gets put together and there's a better offering out there.
Yeah, I was just going to say that, you know, this comes down to responsible optionality, right? We have to move from a passive store of value on the balance sheet to a productive asset on the balance sheet. And I think that that comes with, you know, a variety of different potential features. Again, not changing the underlying properties of what made Bitcoin Bitcoin. So I think it goes a little bit beyond education. I think that we actually have to put features into the market, connect the plumbing, and actually, you know, give allocators options that they can plug into and utilize today.
That's great. All right. Thank you all.
Thanks, Josh.
Thank you.
Thank you.
Let's give it up one more time for our panel. Thank you, gentlemen. Okay, how are we feeling? Everyone good? All right, cool. A couple quick housekeeping notes. One is during the live sessions, our AV team has notified us that walking down the center aisle will put you in the shot. So unless you're trying to photobomb the live stream, please stay out of the center aisle, use the sides. And we have a few more panels here before we take a networking break, so thanks so much for sticking with us here. We're going to keep things rolling with our next panel on macroeconomic trends and price action, so hoping this one will be a little bit extra spicy. Please welcome to the stage our moderator, Sam Callahan, and the panel.
Yeah, someone's missing. Hello, everyone. All right, we're talking price action and macro. Exciting time to be doing that. I think we're at the part of the cycle, if we could simplify the Bitcoin cycles. Bitcoin is a bubble and Bitcoin is dead. We're clearly in the Bitcoin is dead. I happen to enjoy these times immensely. Let's start with the price action. That's like the elephant in the room. Let's go like one by one. What do you guys think is some theories around Bitcoin's underperformance compared to, say, equities and gold over the last 6 to 12 months? Let's start with you and just go down.
Yeah, hi everybody, I'm Henry. I guess I didn't end up on the panel, but I'm from Silicon Valley Bank. I think the main kind of takeaway for me is it's always the question of liquidity. Where is liquidity going? Where is liquidity coming from? And today, all of liquidity is going to AI, and we're starting to see more and more of these mega IPOs happen, which means that there's an unlock, actually, of liquidity for people who are tech curious. So for me, we're at this point where we've seen liquidity move from higher risk assets into AI, where people think that, you know, their capital might be safe, or it might actually have some kind of underlying value. And now, as some of these unlocks start to happen with IPOs, and some of these AI companies are starting to potentially top out, you'll actually see a movement of liquidity from those to higher risk assets or longer tail assets, including Bitcoin.
There's a lot of shiny things out there right now, and it's moved liquidity. I mean, I'll give an easy answer, right? Warren Buffett famously said, when people are fearful, be greedy. So this is not investment advice, but that's certainly my ethos right now.
Greg Barasia from Kraken. Look, I think from my perspective, Anyway, mic's acting a little weird. But I think that when I look at asset pricing, I think about it kind of relative to both the real and nominal yield curve. So what you've seen over the last 2 to 4 weeks is you've had inflation expectations like completely drop. When you look at 1-year forward inflation swaps, they're down by like 95 basis points. At the same time, nominal 2 years have continued to rise. So you've had this kind of like flattening of the real yield curve. So in the near term, you have this higher real yields, which kind of weighs on the interest differential aspect of any kind of risk asset or currency. But the market is starting to price in potential demand destruction due to kind of this oil supply shock. So, I think when I look at asset prices in general, and maybe Bitcoin more specifically, that lens for me personally is somewhat helpful.
Yeah, the only other thing I'd say is, probably going off you, Gregory, is just the macro picture in general, like the uncertainty around the conflict in the Middle East, the whipsawing, is there a peace deal, is there not? There's still a lot of uncertainty, and as you said, inflation expectations are rising. We got a new Fed chair coming in, Kevin Warsh. He had an interesting speech last week, kind of talking about how he's going to change some of the things internally at the Federal Reserve. Do you think that Kevin Warsh, being the new Fed chair, is impacting risk assets, anything of the speech or the potential of a new Fed chair kind of changing monetary policy?
Yeah, I don't know necessarily how much it was Warsh himself. Look, ultimately his main response to every single question was we're setting up a task force for that. So he himself, and also he didn't put a dot out there, right? So of the 19 dots, there was only, or the 19 members of the committee, there was only 18 dots because he decided not to put a dot out there. But I think it was the hawkish bias of the dots, right? So essentially you went from having a median of 1.5 rate cuts to essentially flat for the rest of the year. But I think what wound up happening was the market said, okay, if we're going to have more hawkish monetary policy, it's actually going to lead to more demand destruction, coupled with the fact that the oil price shock is more of a tax on the consumer. So you've had the initial, to your point, inflation expectations skyrocketed, but over the last 21 days or so, they've come down by like 100 basis points. So it's been this kind of like massive whipsaw where if you assume that you're going to have like more hawkish monetary policy and ultimately demand destruction in the economy, you have higher real yields, but that's because the rate expectations on the nominal curve have not caught up to the expectations on the inflation side.
I also think you have something to do with uncertainty here, right? Markets, generally speaking, hate uncertainty, and we've kind of lived in this bubble of uncertainty over the last year and a half. So when you look at risk assets outside of the AI bubble, I keep going back to that, you're seeing that reflect in price action. And I think once we start to have more certainty in the market, once we start to have more direction, and if we can actually start pricing what might happen with more certainty, you could see an evolution of the kind of the next wave of risk assets.
One of the trends over the last couple of years was there was the launch of the ETFs, and then the share of circulating supply of Bitcoin held by institutions and funds have ballooned over the last, say, 4 years. It went from basically nothing to now almost 20% of the circulating supply of Bitcoin is held with institutions or funds. Do you think that's influenced Bitcoin's trading behavior at all?
I think it's the same buyer. I think people have just moved money off of chain. So people who are buying IBIT in their brokerage accounts, most of those folks, at least that I speak to on a day-to-day basis, are the same people who used to hold their wealth on chain. And so I think that you're seeing this rotation happen of, yes, more people are buying in their brokerage accounts, yes, there's more access, but I don't think that necessarily changes who the end buyer is outside of large swaths of institution coming in and saying, okay, we're going to allocate 5% of our balance sheet to it.
Yeah, I'd echo, right? The institutions aren't exactly in yet, but we run an exchange, right? And most of our volume is with traditional, boring banks. They're not.
Hey, we're not boring.
Exactly. But they're almost there, right? And we built a digital business circa 2018 in response to these clients that were asking for it, right? And so they are trading. They're doing hundreds of millions, maybe $1 billion a day, right? Versus a franchise for us that spans 70, 80 billion, so small, but has been meaningfully increasing every year, every quarter, and that's just the trend we see with the clients, with volumes, with the counterparties we're dealing with. So it's clearly one way.
I actually think the more interesting metric will be over the course of the next 2 years when we see more and more commercial banks offer custody assets, what that turns into in terms of who's holding Bitcoin on their balance sheet. Is it the traditional fintech company that's now holding Bitcoin on their balance sheet because they have access to USDC rails in their commercial banking account? I think that could actually be the catalyst of what happens for the next cycle outside of quote unquote institutions buying. It's going to be the individual institutions on the fintech side, not just the asset managers.
Interesting. So you think the trend of, say, stablecoin adoption that's exploded will actually lead to more Bitcoin demand?
Yeah, I mean, think about what a commercial bank is, right? Commercial bank is, okay, great, you give me your fiat today, I'm going to custody that, I'm going to keep that safe, and you can go out and do your operational activity. If all of a sudden those clients have access to stablecoin rails and then therefore have access to swaps into the large assets on chain, then there's this whole other metric of demand that people are not even measuring today.
Interesting. One of the, things I hear a lot from more like traditional finance people when they view Bitcoin, they say, oh, it's just a leverage tech play. And do you guys hear that in your conversations? And do you view Bitcoin that way?
I mean, I hate to repeat myself, but I would look more at the steepness of the yield curve, right? I mean, ultimately, you could argue that a steeper yield curve is better for equities, which then leads to a correlation with Bitcoin. But I don't think that's necessarily like correlation being causation. I think to the extent that you have lower real rates in the short end and you have higher long-term rates, which would denote either some level of global growth and or some kind of potential monetary issues, that's probably the best opportunity for Bitcoin to continue to perform well. It does happen that in that environment, tech also does well, but I don't think they're necessarily causing one or the other.
And it's more so than that, right? There's also, if you look at the broader industry, there's fundamental use cases. There's real-world adoption, right? Stables, the ability to send remittances all over the world, applications on blockchain. These are real things that are providing real value that you can credit Bitcoin to a large degree as being the catalyst and the support layer for. So there's definitely that aspect that I think is important.
Yeah, I actually started my digital assets journey in 2017 selling structured products to family offices under the thesis that they were not correlated to tech stocks, because back then it wasn't the case. And I think what we're seeing now is it is a leveraged bet, but to your point, Greg, it's a leveraged bet based on liquidity, and it's a leveraged bet based on risk and how consumers and how institutions are willing to lever up their risk.
And also the other thing I'd say is, like, you could argue ever since the war started in Iran, correlations across assets have gotten to 1. I mean, oil is becoming increasingly correlated with equities, some of them being positive 1, some of them being negative 1. But essentially the market is trading on a couple of major geopolitical themes, so naturally you're getting increased cross correlations across the board.
Yeah, you can make that same argument for access, right? And the ability and ease of trading, right? Hyperliquid has allowed for ease of trading for oil and for other things that typically a retail investor might not have access to outside of derivative products. And now that you do have access to those and people are trading those on an active basis, you're seeing additional correlation.
I think the increased correlation with equities is actually a sign of Bitcoin winning because it's becoming more integrated into the traditional financial system. And then it's having a shared investor base, more institutional investors owning it, looking at it in a whole portfolio, and then having the same risk management. And so you see this with emerging market stocks. A couple decades ago, you saw that with the hedge fund industry, where they were initially, it was all about the lack of correlation with but as they were adopted, as more investors allocated to those sectors, they actually grew in correlations because it's just shared investors doing the same things, looking at the portfolios. And so as Bitcoin to traditional asset classes, but fundamentally different value proposition than an equity. Equities of a claim on future cash flows. It's valuation multiples, profit margins, earnings growth. Bitcoin has none of that. Bitcoin's driven by its monetary properties and its network effect. It's like a function of how much the fiat's being debased, the openness of capital markets, the credibility of the traditional banking and financial system. That's what drives Bitcoin. So I think this idea that it's a leveraged tech play if the correlation's just tied up over the past like year or so, it's wrong. I don't think that's how investors should view it. They should view it as a separate bucket that's hedging against a risk that equity, bonds, cash cannot protect against, which is the credibility of the issuer of the currencies, so the fiat currency debasement. So I think like that will come more and more as more investors learn about Bitcoin. But right now, it's still viewed broadly as a risk asset. But I think that's changing with some of the narratives around BlackRock and these other, the way that the education is occurring. So that should change over time. But with institutional adoption, I think looking ahead at what's a potential tailwind for Bitcoin to kind of pull us out of this bear market. When the ETFs launched, the institutions are coming. That was the narratives. They're coming. But I think we all agreed on our call when we were prepping for this panel that they're not really here yet. It's like extremely, extremely early in terms of the adoption there. You guys all are building in this space, actually providing the infrastructure. So how can we kind of drive that trend more? Where are there gaps in the market that you see? Where does building need to take place? What are you excited about that could really move the needle in terms of getting more capital flowing into this asset?
I'm glad you mentioned infrastructure, right? Like we are an infrastructure provider. We match buyer and seller at the end of the day. But to tie that into macro, right? Macro, I have macro traders next to me, so they'll be able to speak to this a lot better. But macro is everything. Inflation, international relations, politics, everything. So you can imagine trading macro themes is quite difficult. And there's a really interesting study that came out this week where an investment firm, they put out a simulation where they asked a bunch of traders to trade based on forward guidance or forward knowledge. It was like, you can trade on Monday, but you had access to Wednesday's Wall Street Journal. Turns out, and they can buy whatever they want, they can apply leverage, they can short. Turns out they did not do so well. I think it was 50% lost money, something like a sixth went completely bust, and the rest made very nominal returns. So not only is trading macro difficult, but even if you have a crystal ball, even if you know what's going to happen, you still don't necessarily do that well, right? And I think the lesson from that is that it's not so much direction or which asset specifically. I think it's more about exposure, the leverage component. And in my mind, exposure is a function of risk, and risk is a function of infrastructure, right? How do you manage risk? Prime brokers, that's literally what a prime broker does, right? Custodians, qualified custodians, exchanges, right? This is the infrastructure that, in my mind, needed to grow and scale and has, to a large degree, that is creating that catalyst, right? And that's why you see qualified custodians. You'll be hearing from Mike Belshi later. That's why you have regulated exchanges like LMAX. That's why you have actual prime brokers, traditional prime brokers that are participating in the asset class. We're working with a lot of them, the traditional names, right? I think that's going to be the one of the most important catalysts.
Yeah, look, building off of that, and by the way, it's from a place called Elm Wealth. It's a really fun exercise. Yeah. It's actually much easier to do the interest rate predictions than to do the equity predictions. But look, what we're doing at Kraken, which is maybe a longer term tale, is the idea of like, at the end of the day, whether you have an asset that's denominated in Bitcoin, Ethereum, fiat, anything, and you want to invest that into any other type of opportunity, whether that's real world opportunities, another crypto opportunity. The example I gave these guys on the prep call was, if you're a Bitcoin holder that wants to hold or invest in a manufacturing plant in some place like Ohio, we're working on figuring out ways to structure those opportunities so that ultimately you really get the convergence of kind of traditional finance and modern finance using our, to your point, infrastructure, our distribution, the clients that we have. And then you really start to look and see that there's no difference between a firm like Kraken and a firm like JP Morgan. It's just that we're doing it in kind of a more modern and sophisticated way.
Yeah, I think my point here is kind of threefold. One is trust. I think trust is completely eroded on chain at the moment, which is part of the reason that these large financial institutions need to come in, commercial banks, prime brokers, exchanges that are trusted so that users can actually feel secure in the asset that they're holding. They don't feel like they're going to get drained. They don't feel like the platform's going to get hacked. They don't feel like their funds are going to get frozen. And I also think it's an access thing, right? So to your point about institutions, yes, institutions were coming when we rolled out the ETF, but really that was access to retail traders or to 401ks or to the individual who's using these brokerage accounts. The access to actual institutions is still actively rolling out, and I think that's where we'll start to see some of the more interesting price fluctuations potentially. And obviously none of this is financial advice, but when we start thinking about how much capital is sitting stagnant, how much capital is not being used on people's balance sheets, what's the yield that's available for overnight sweeps versus other things that you could potentially allocate to. And then the last point is we're seeing a massive amount of VC funding still coming into the industry. Framework just announced a $400 million fund. Han Ventures announced a $1 billion fund. A16Z's $2 billion fund, right? So these are all going to go into additional infrastructure plays that allow for additional access, that allow for more creative ways to put your Bitcoin to use or put your on-chain holdings to use. And I think that will also be a catalyst to allow for just overall sentiment to change in the industry. And part of price action is obviously predicated on sentiment.
Yeah, the only other thing I would say is improving investor access by embedding Bitcoin as collateral with different structured products that fit investors' needs, different cohorts, different investment mandates. I mean, you're seeing that with Strategy, the Treasury companies. But it's not just that, too. I mean, for instance, Battery Finance is another example of a company that are trying to tie real-world credit assets with Bitcoin and dual collateralized loan structures. There's all types of companies building like that, but it's still the early days. And I think Bitcoin as collateral, as pristine collateral, being embedded will help drive the adoption of Bitcoin to new heights, to be frank. Now, when I think about looking kind of forward at the macro picture today, there is a lot of uncertainty. What's like one area of the macro picture that you think is important for investors and individuals to pay attention to kind of get a sense of where things might be heading? Like what's a metric or certain policy that you guys think is really important?
You're the macro trader here.
I've already talked about yields, so give me a couple of seconds to think about something else. I mean, look, in terms of policy, obviously everyone here is aware, Clarity Act going through Congress, I think is something that everyone should be thinking about, especially given the fact that, I think it'll be increasingly difficult to get anything done as we get closer to midterms, and, if, there's a divided Congress after November, potentially nothing gets done. So as a kind of a cop-out answer, I'll give you guys that one.
It's not a cop-out, right? I think regulation comes up on every panel because it is the single most important driver for adoption in the US, hands down, right? That said, I think we already have a lot of regulation. And we have a lot of templates, right? We need clarity to pass for a whole host of reasons, but there are already frameworks that exist that, frankly, all clarity will do is just push things a little bit more onshore US, which is important. And if I was a politician, I would be thinking jobs, I'd be thinking about everything that comes with it, which is why it's attractive. But really, right, the train is kind of started, and it's from a US perspective, it's our game to lose, quite frankly.
Yeah, I completely agree with that. You're seeing foundations of protocol companies starting to come onshore again, which I think is great. A great sign of just adoption, generally speaking, and where regulation's heading. My answer is slightly different. I actually think the private credit market is something that's extremely interesting to watch and see how private credit is actually getting rolled out to smaller and smaller consumers or smaller and smaller borrowers. So the folks who are saying, okay, great, you can collateralize $10 million worth of equity instead of it just needing to be $35 million worth of equity or 50 or 100 or whatever it might be for a typical bank to actually underwrite that loan. And that way you have more liquidity flowing through the system at a higher pace and a faster time frame. And I think that's going to be extremely interesting as you're starting to see these companies go from $0 valuations to $60 billion over the course of a 3-year time frame, and you're minting billionaires over the course of a much faster clip than we've ever seen.
Yeah, it's interesting. Mine's pretty simple. I look at the governments and I ask, are they still running massive deficits? Are they still spending recklessly? Because when you look at large, highly indebted governments, historically, when they can't plausibly tax their way out of it or grow their way out of it, they turn to one thing. They inflate the debt away nominally, and then the currencies absorb the damage through lost purchasing power, and then financial repression and capital controls follow suit. That's the macro environment that Bitcoin was designed to thrive in. So with that, I want to thank everybody here. I appreciate all your insights, and thanks for building the infrastructure that helps drive Bitcoin.
Thank you.
Thank you.
Thank you, everyone.
Let's give it up one more time for our panel. Thank you, guys. All right, we're getting better at that, right? Good job, guys. If you can hear me out in the lobby, we want to invite you to make your way in for this next session. We got a couple more before we take an intentional networking break, so you can pick up those conversations at that time, but we'd love to fill this room up with some more people for our next panel here on the ADR. Here to introduce our panel is Loren Asmus from UTXO Management. Please welcome to the stage.
Good afternoon, everybody. My name is Loren Asmus. I lead investor relations for UTXO Management. We're the asset management arm of Nakamoto, and we invest across public and private opportunities in the Bitcoin ecosystem. Today, we're talking about Bitcoin ADRs. And so I think it's a very interesting space that's really growing out, very old technology, but kind of a revision of how Bitcoin can be involved with this. So we'll start with introductions. Ishaan, if you could introduce yourself and your firm and a little bit about your background.
Thanks, Loren, and thanks everyone for being here today. So my name is Ishaan Narain. I'm the co-founder and CEO of RDC. RDC is the first firm that's in the business of issuing ADRs on Bitcoin. Prior to that, me and my co-founders were formerly at Citibank for a bit over a decade. We issued ADRs on a lot of cross-border equities from Alibaba, Nokia, Nestle, Nintendo that help connect markets. And what's exciting is, as you guys heard earlier, we're starting to see that ADR bridge as well apply to treasury companies in the Bitcoin space like Metaplanet. And excited to talk to you a little bit about what the ADR has done for Bitcoin as well. So thanks for being here.
Awesome. Thanks. Pleasure to meet everyone today, and thank you for attending. My name is David Martin. I'm the Chief Revenue Officer for the digital team at ClearStreet. ClearStreet is a traditional prime broker that is fully integrating crypto prediction markets and tokenization. My background has primarily been focused on originally quant trading and TradFi on the macro side. 2015, I found out that crypto exchanges gave away free data, so I jumped into crypto. Was trading crypto for 5 years, and then I was an early team member at FalconX to build out the crypto prime brokerage business there. And looking very much forward to talking about ADRs today.
Great. So Ishaan, let's get right into it. What is an ADR? Let's level set here with the audience.
Yeah, so maybe before getting into what an ADR is, I'll just give some historical context on the idea of a receipt. So the idea of a receipt has been around for hundreds of years, going back to the 1600s when goldsmiths would hold gold on behalf of customers and give them a receipt that gave them a claim to that gold and allowed them to basically feel comfortable kind of holding that gold, which then eventually opened up trading and kind of like founded the modern banking system. 100 years ago, so a little bit more recently, but still quite in the past, an ADR was the first kind of receipt that basically connected equities across markets. And the idea was basically letting US investors own foreign stock in a US brokerage account without having to worry about setting up a brokerage account in a foreign country, without having to worry about regulations in a new country, or worrying about mandate restrictions. And that product has blossomed, and it continues to be a product that's used today to connect markets and bridge markets. So with that context, we had the idea that the ADR should be innovated to the next evolution of the product, which is to bridge an asset like Bitcoin that, whose time has come, which needs to be integrated into traditional finance, which needs to have the ability to be used in the traditional finance system through this wrapper, which is the ADR. And so that's what we've done. We've effectively wrapped Bitcoin directly into an ADR, which connects the two markets, which lets asset owners that own Bitcoin hold it as a stock at a brokerage account while continuing to own the underlying asset. And so while they own Bitcoin and they hold it as a stock, they can leverage it for all the utility that a stock gives them. But they also have the choice to go back to the underlying. So it's not like they're giving up ownership of the underlying. This also opens up the asset to the traditional market to a lot of investors who don't have the ability to hold Bitcoin directly, and we'll be talking a lot about that. But we're excited to integrate Bitcoin into the traditional market and open up more choice for asset owners, for Bitcoin holders, and for the broader market in general. So that's effectively what the ADR is and what it's done for Bitcoin.
And maybe to expand on that, Ishaan, the number one question that I receive when we talk about this with people is, what's the difference between the ADR and an ETF? Like, can you explain why the benefits of a DR versus, say, just owning the ETF in your brokerage account?
Yeah, absolutely. I think when you think about an ETF, which is a fund that helps investors get exposure to the underlying, it's obviously been a very effective product at bringing investors the ability to get exposure to Bitcoin without having to deal with being on chain, if that's difficult for them or if that's a challenge for them. But I guess the difference here is with an ADR, when you buy an ADR, you have a direct claim on the underlying Bitcoin. You're not buying equity in a fund. You're not relying on a trust. You're not relying on a third party to manage your Bitcoin for you. It's still your Bitcoin. It's just being held in a more convenient wrapper for you to use it in the stock market. It's also a product that you can redeem directly into the underlying Bitcoin for. So it's not limited to authorized participants or certain banks or brokers who have the ability to access the underlying or have the ability to touch both sides. It's open to everybody. So any asset owner that owns Bitcoin can deposit that Bitcoin with a custodian. We would issue them an ADR in their brokerage account. They still have claim on the underlying asset. It's still their Bitcoin. No one else can control it or touch it. And then they can use it as they'd like. They now have the choice. They can hold it as a stock. They can redeem back for the underlying. It's completely open. And that's kind of what we want to bring to the market. More choice, more optionality. The Bitcoin always stays in custody. There's no movement of Bitcoin. Nothing is being sold to cover expenses like you would in a fund. The idea is that your ADR is a direct claim on specific units of Bitcoin that stays fixed regardless of the price action on Bitcoin or on the ADR. So it's a product that allows you to continue to own the underlying, to access the stock market, but also have the choice to come back whenever you want. And so that's kind of where it differentiates from, say, a fund or an ETF.
Yep, no, appreciate that. Dave, can you talk a little bit about the prime brokerage benefits perspective on a potential Bitcoin DR?
Yeah, sure. I think there's a couple of key use cases that come out with this. Number one that I would say, kind of going into the DR structure versus ETF, there's definitely room for both, but they allow for different things. And I think one of the most interesting unlocks that we have been talking to clients about with the depository receipt is that funds like an actively managed ETF or a mutual fund fall under the Investment Act of 1940. And one of the rules, which is 12D1, limits the amount of other funds these vehicles can own. And so if you take something like an ETF, the 1940 Act rule says, well, you can only have up to 5% of your underlying exposure in another investment vehicle. And you're limited to 10% overall within your fund of owning other fund vehicles. And so if you take a look at, like, a ETF versus depository receipt, this depository receipt doesn't fit within that investment vehicle framework because, to Ishaan's point, it's a physical representation of the underlying asset. And so we see and have been talking to a lot of customers and prospects about the ability for actively managed ETFs, mutual funds, even passive ones, to be able to own more Bitcoin through a depository receipt framework. And so that, I think, has been like an overall theme that we have seen. Outside of that also, there's been a lot of customers as ClearStreet continues to build out the digital offering. We have a lot of customers that have been calling and saying, I want to be able to hold my crypto at ClearStreet. And it gets an interesting conversation around rules of what you can hold in a broker-dealer versus a non-regulated entity. But one of the more interesting things that comes out about it is that owning crypto in the traditional rails allows for better margining, cheaper financing potentially, securities that end up being eligible for repo markets. And then also, like on some assets, you get paid to hold them at your prime if you make them eligible for SEC lending. And so there's a handful of key use cases. And I view the depository receipt, like one of the key themes. I've been in crypto for 11 years. One of the key themes that everybody talks about is interoperability, right? And I feel like this is a great structure of interoperability between the crypto world and the traditional world. Because as more and more traditional firms want to get in, there's space to hold the underlying spot. But this allows it to seamlessly integrate with the traditional financial rails and provide a number of different benefits and unlock new use cases.
And progress is already being made. David, if you can talk a little bit about the announcement that ClearStreet came out with today between all three of our organizations.
Yeah, we're really excited to do it, and kind of going back in history, Ishaan and I have been working on this for the better part of the last 3 years, and so very excited to come out with a press release this week on executing the first DR transaction in combination with UTXO and GTS securities. And you know, what I would say overall is it's generated a lot of inbound. ClearStreet's clients are primarily traditional institutions. And a lot of people are coming to us asking us, how do we hold this asset? What is it? What are the benefits? What are the underlying use cases? And I think it's been really interesting across support, both from people internally that are asking questions, like folks on our risk team about how could we effectively margin this security? How do we provide more benefit to our underlying customers? What does the liquidity profile look like, right? Because they're going to look at it from a risk perspective. Clients are asking us particularly about the 1940 Act rule. Does this unlock us to be able to get more exposure to Bitcoin if the market is telling us that that is what we want to do? And so I think the amount of inbound, obviously, particularly with everything that's going on in New York City this week, has been awesome. And there's a lot of questions, but people are looking at it, particularly those that are coming into crypto now as a potential solution to solve a lot of their underlying issues with holding crypto in the more traditional sense and worrying about all the underlying wallet infrastructure and security. This gives them direct access to something, and they can hold it in a prime broker or broker-dealer account, like at ClearStreet.
Anything to add to that, Ishaan?
No, I think just at a higher level, the product so far and what we've been talking about in terms of what's out there is so far has been restricted to being kind of institutional only, limited to accredited investors and up. And that's just the nature of the fact that we're innovating something. And so, you know, the regulatory setup wasn't really there to go beyond that. But what's exciting is, you know, we now have a path to expand this product so that everybody can access this. And so we're in the process of registering and listing this product on a stock exchange, opening it up to the broader market, letting every Bitcoin holder and future Bitcoin holder through the ADR get this access. So that's what's exciting. All these use cases that are being opened up really help a broader market coming into the space and helping the Bitcoin sort of ecosystem grow, because at the end of the day, the idea is not just to give people exposure, but to actually own the underlying, which is really in line with the ethos of Bitcoin. So that's what's really exciting about this.
Yeah, and I think one more thing to add, like particularly when talking to more of the folks that have been in the digital space for a while, you know, I think BitGo came out with WBTC a long time ago to make Bitcoin be able to be utilized in Ethereum-based DeFi applications. And so when having conversations with a lot of customers or folks that are in the crypto community, a lot of those folks are now looking to also get exposure to publicly listed equities that are related to the crypto space, or AI, data centers, miners, et cetera. It all kind of goes together with emerging a frontier technology. And this opens up use cases for Bitcoin to be utilized as collateral. But going back into like the WBTC or CBBTC scenario, that effectively took Bitcoin and put it on an EVM compatible chain. This is effectively putting it on the quote-unquote TradFi DTCC chain to make it compatible with the traditional ecosystem.
Yeah, we're going the opposite direction. We're taking the best, in my opinion, crypto asset, digital asset, moving it from a digitally native on-chain to now within TradFi rails where you can access potentially traditional margin, options, all the other benefits you have for having a security in a brokerage platform. And yeah, we were really excited to work with both RDC and ClearStreet on this transaction. I mean, effectively what we did is UTXO had Bitcoin, we did a create through RDC, and then that DR was with ClearStreet in our prime brokerage account, and then did a trade through the DR. And so the proof of concept worked very, very well, and the first of hopefully many more steps and progress along the way of this journey. I want to circle back and just level set a little bit more on, obviously to your point, Ishaan, that the ADR has been around for 100 years plus. Why is Bitcoin uniquely, in terms of its value prop, kind of a glove fit for using the DR wrapper? Like why could this potentially be a big idea versus other foreign stocks or gold or other commodities in the past?
Yeah, that's a great question. So I think it goes back to something I said earlier. Bitcoin's ethos is about ownership, it's about choice, it's about people having the freedom to decide what they want to do with their assets. The idea of an ADR is to enable that ownership, is to open up a bridge that lets you continue to own what you own, but gives you choice to use that asset as you like without losing that ownership claim. And that's fundamental to what the ADR enables, and that's fundamental to what Bitcoin is. It sort of fits in perfectly in terms of how the product looks at the underlying asset. And so that's what's really exciting. You also have a lot of holders of Bitcoin today, right, that don't want to give up their Bitcoin no matter what, which is their right and which is something they should be able to do. But they also should be able to monetize what they've earned. And that what they've earned is the appreciation that Bitcoin has given them over a long time. And so the opportunity to be able to convert that Bitcoin into a stock, access traditional margin, traditional funding rails, a consistent source of funding, no risk of insolvency on the lender because you're talking about banks, brokers that are very well regulated, and access to stable funding and access to utility with the ability to go back to the underlying whenever you'd like is something that's fundamental and something that should be available to everybody, which is what continues to get us excited and why we think Bitcoin's a perfect asset for this kind of a wrapper, and this wrapper is here to enable that option for everybody. So that's how we feel about this fit.
Yeah, and I mean, a couple of things to add. When I was in traditional finance the first time around, a long time ago, I ran an emerging market portfolio. And it was a hedge fund. There's a lot of clients that came in that were asking for separately managed accounts. And when you're running an emerging market portfolio, you're trading in a lot of emerging markets, and it gets quite expensive to set up all the brokerage relationships on the back end to allow for people to have all of this underlying access to all these markets. And so back in the ADR firm, I used to trade a lot of ADRs back then, and we'd go to Thailand and Indonesia, and we'd buy the ordinary shares, and we'd work with Citi or Bank of New York to do the conversion. And that enabled accessibility for a new swath of customers. And we were really one of the first people back then to embrace full portfolios of unsponsored ADRs, and which enabled us basically to buy anything that we wanted and use this depository retreat framework to bring it in and give clients unique access to something that they weren't able to do. And so when I heard about the depository receipt idea a few years ago on Bitcoin, my mind went to the same place. It is enabling people to get access and get more utility out of an underlying asset. And I think particularly right now in the state of the market that we're in, it's really interesting to see all of the progress that has been made over the past couple of years. There's an accelerant of traditional finance coming into crypto. Everybody is talking about how do we tokenize everything and bring it on chain. While that is also going on, and we want to be very, very supportive of that, it's going to take a long time to get to that end state point. And this is really where something like the depository receipt comes in, because you need to be able to seamlessly go from the crypto world into the traditional world and then have it seamlessly move back. And because it is a in-kind create or redeem as an option, people are able to do that and seamlessly move. And whether it's a market maker or a venture fund or an asset manager, that unlocks new utility and seamless integration between the worlds.
Those are all really good points. And even just from our perspective at UTXO and Nakamoto in general, is the fact that you can now educate on the tenets of self-custody and holding the Bitcoin yourself, kind of going in the reverse way, right? If you're a person who is investing in Bitcoin or buying Bitcoin for the first time and you feel more comfortable doing it on your brokerage account, you can first get comfortable seeing how it interacts, how the price moves. But when you're ready, now you have an option to where you can do your own redeem, hold the Bitcoin yourself, and learn about self-sovereignty and learn about all the tenets that we all are here for Bitcoin. And so it's a way, we view it as a way to orange pill more people into the Bitcoin ecosystem and economy, which is very, very exciting. And so we have about a minute left, but Ishaan, David, any last thoughts or comments before we wrap up?
Yeah, just, one way to think about what we're doing here is, as we've been saying, expanding option, expanding choice. And what's great is, there's already so many good products out there that have solved different needs to allow people to get access, exposure to Bitcoin, whether it's the ETFs, the Treasury companies, et cetera. And that's going to continue to serve various investors. And we're excited to have the ADR as now a part of that option set so that people can decide, what's the best path for them. And we're excited to make this a way for this asset to be more mature, a way for this asset to be integrated into traditional finance. And so that's really exciting. This opportunity is great. Regardless of what's happening in the market from a price perspective, the long-term thesis is the adoption continues and the ecosystem broadens. And that's what's really exciting, and really excited to be here and talk about this today.
Yeah, and I would just say kind of 2 quick points. Number one, I think adoption, right, is the key factor, right? And we've continued to see more and more and more adoption of Bitcoin in further utility, right? And this is a option to provide different fungibility and use cases within the framework of what BTC represents, as Loren mentioned. I think the other thing for us as a prime broker, we get really excited about being able to be this bridge between the digital world and the TradFi world and seamlessly integrate back and forth. And this is a unlocking mechanism for a lot of folks, particularly that are managing other investment vehicles or folks that want to use it as collateral and get margin or use it in repo. And so there's a nice unlock mechanism that just happened in a very short period of time that is coming to market. And people are building on-chain. We need to be building on-chain. We also need to be figuring out how to make these two worlds coexist together.
Great way to wrap it up. Well, please join me in thanking our panelists today.
Thank you, guys. All right, we've been practicing this, so let's give it up one more time for our panel. I like it. You guys are crushing it. If you are in the lobby, we'd invite you to make your way into the stage area for our next session here. Excited for this conversation. Bitcoin as the hurdle rate. This will be our last session before we take a quick break. So please help me welcome to the stage our moderator from Nakamoto, Amanda Fabiano.
Yeah, right. All right. Good afternoon, everybody. My name is Amanda Fabiano. I'm the COO of Nakamoto. I feel like we could do intros as you're going through what you are in the first question instead of spending like 10 minutes on who we all are, if that's okay. Switch it up a little. Okay. We've seen an explosion of companies adopting Bitcoin Treasury strategies over the last year. My personal take is simply holding Bitcoin is not really a company strategy, right? It's a balance sheet strategy. So the real question I have for all of you is what creates enterprise value beyond Bitcoin? So if two companies hold the same amount of Bitcoin, why should one be wanted more in the market? Jeff, you want to start?
Sure. I think the holy grail that everybody is looking for as a Bitcoin investor is a way to make that Bitcoin productive. And I think people generally call that Bitcoin denominated yield. And what they're hoping to achieve is if they can make Bitcoin plus type of return by finding some idiosyncratic return streams. And I think Bitcoin treasury companies represent a version of an operating execution towards that goal. And some do it by building real cash flows that are coming from real revenue from actually running a business that then get into buying Bitcoin that accrues to ownership of Bitcoin on a per share basis. And then there are some like Strategy that actually is just financializing their capital structure to give you leverage that only corporations can access that you and I could never really access as retail investors, to give an accelerated vehicle that could allow for some upside participation that just looks different. So I think to summarize it all, it's to find yield that is Bitcoin denominated so that over time your capital compounds hopefully a little more accretive than just even holding Bitcoin if you're a long-term believer.
Yeah, that sounds really smart. Like I'm just more a traditional business guy. So I want to be in businesses that create massive operational growth and operational capital, and then store it in the best form of sound money. So, this panel is called, is Bitcoin the hurdle rate? I think the question is the hurdle rate from the balance sheet or from the business? And I think this notion that Bitcoin companies or treasury companies is like a weird thing to me. You're a great conference company that then makes cash flow that then drives to the Bitcoin treasury. You're a great hotel company that drives cash flow that then drives to the business. I think one of the more interesting ways that Saylor puts Bitcoin is it's basically energy money. Well, if energy is invented and we have electricity and then we just store it in a battery and we don't do anything with it, it makes zero sense. So what's a good company? The company that uses the energy. The better you use the energy, the better the company. So the faster the company's growing, the more operating leverage the company's growing, the better the company. And if they put it in sound money, even better than that.
Yeah, I agree. That's basically what I was going to say is you as a business, as a company, need to make cash flows, revenues, profits. And the key difference is you view Bitcoin as the best, most pristine money that we've ever had, and you're willing to ride out that duration, the volatility that goes along with it. But you think of any big company out there, they have a fortress of cash, and their goal is to not lose that cash, have no volatility. You can kind of flip it on its head with a company that has Bitcoin as its treasury asset, where the goal is to withstand the short-term volatility with the understanding that this is a 15, 20, 30% CAGR asset over the next 10, 20, 30 years. So agree, Bitcoin is money, Bitcoin is digital capital, it's all of the above. And why not back your business with the most pristine collateral we've ever known?
So one thing that has driven me a bit crazy with the market is the reaction when Bitcoin companies sell Bitcoin to do whatever they need to do for their business. So if we are saying that Bitcoin is the future of money and it's the best money ever, and we operate in a world where you can't really pay your employees or anything else or any bill with Bitcoin, why is the market dinging people for using their Bitcoin instead of as cash? If you hold the Bitcoin on your balance sheet, it should be looked at as an equivalent of cash. And it's obviously everyone thinks that Bitcoin is going to go up, so you would be upset if someone sold it, but the companies still have to operate. So we saw it with Saylor got dinged for selling 32 Bitcoin, which I think is insane because he has a ridiculous amount of Bitcoin. So curious your thoughts on like when will the market shift happen where it will be normalized that using Bitcoin to run your business is okay? Will it ever?
Yeah, I can kick this one off. Look, if you're an executive team of an operating company that is publicly listed, your number one duty is to deliver shareholder returns. That is it. Bitcoin can be a lever to do it, and that's why some of the investors are aligned, but ROE is your number one metric. So if your cost of capital at a moment in time is such that selling Bitcoin to reinvest into a higher ROE, whatever that operating experience may be, then that justification should permit some ability and flexibility to do it. So then the question is, how do you drive higher ROE? And I think on that front, the industry hasn't always necessarily delivered the promise of actually translating results. One very obvious example is, look, we all know Bitcoin's very volatile, right? It has peaks and troughs and drawdowns in ways that you could imagine that certain moments in times selling Bitcoin to do something else could drive higher ROE. And that's not a passive strategy. That's actually a pretty discretionary alpha-centric strategy. So if, for instance, Saylor chose to actually not buy Bitcoin every single week and decided to be a little bit more discretionary about preserving the cash to then maybe buy now and not for the last 9 months, and proved somehow that you're actually bringing an ROE question, then I think you have a little bit more of a conversation where somebody could appreciate these capital decisions and allocation questions. So in the end, I think the challenge so far has been that ROE promise has not seemed as obvious from the outside in ways that I think we're still living the journey of what that terminal state could look like.
Yeah. I think Bitcoin has a marketing problem. And the marketing problem is this. We know of Bitcoin as pristine capital that's inflation resistant, and that's an incredible value, and so it has utilitarian value. But it also has other values. It's instant, it's global, it's accessible to the other 7 billion people on the planet. And quite frankly, as somebody who's been in the space for a long time, I think what I've learned is if you go into the market and you talk about Bitcoin in economic terms and philosophical terms, but you don't show people how Bitcoin is actually used in the real world, people actually don't understand it and they don't care all that much. And so they only care if the numbers goes up. But the moment it doesn't, you don't realize that there's utilitarian value. And so I think a big challenge in the industry right now is Bitcoin, literally in the white paper, is its electronic cash, peer-to-peer money. Okay, so if Bitcoin is not used in the real world and it's not active and in people's hands and touch it, it won't change the world. And why does that matter as an investor and as a form of cash? Because you want properties that are useful. The internet or AI are things that are massively created economic value because they are useful to people. And so I think one of the marketing problems is these companies talked about treasury and store of value, but forgot the utility and the use. And if you don't have utility and use, people don't understand its value. And so my big belief is the best way to get more companies, more institutions, and more of the economy involved is for actually people to use it. We service about 1 million businesses. Today, we operate 2% of the US GDP. I service companies like agriculture companies, the largest manufacturing companies, the largest energy companies, the largest insurance companies. They're not buying it because of the price. They're not buying it because of just its digital gold. They're buying it because it changes how their business operates and gives them operational leverage.
Yeah, no, really good points. And the best way to understand and learn Bitcoin is to actually do a Bitcoin transaction. And you'd be amazed to know how many people have never done a Bitcoin transaction that own either the ETF or bought it in their crypto account and they never moved it. And so I think that's where a lot of the disconnect is the fact that you have a lot of people out there, a lot of institutional capital that has never even done a Bitcoin transaction on chain. And so to your point about education, right? I think that does need to, we need to upgrade that as an industry. But I also think all of us on stage, we view Bitcoin as money, as digital capital. 99.99% of the market doesn't. They view it as a risk asset. And I think that there's been some discussions about, is Bitcoin the hurdle rate or is it the risk-free rate? And like, it depends where you're coming from. And so if I think of a normal company's cash balance, it's like they're effectively investing in the risk-free rate, which is T-bills treasuries, right? because they can't take any volatility. But when you signal to the market that you're selling a risk asset, which is above a certain risk-free rate, right? That has a different view, kind of to Jeff's point on ROE and how the market views that. So I think there's just a lot of things that are being figured out, and this is still a very young, nascent industry where everyone's kind of working their way through what metrics make the most sense.
Yeah, it feels like it's been forever if you've been here for a while, but it really hasn't, and the market is still so small. Speaking of volatility, so we've all been part of multiple cycles by this point. Bitcoin price has always been the focus, but should it be? What are the other risks that people aren't paying attention to that they should be paying attention to?
Well, I think also Bitcoin as a hurdle rate, as a construct, is really coming from because we have this belief that fiat debasement is on the other side that is deteriorating, right? And so holding Bitcoin in itself is a positive EV effort. And so to be more empirical about that pursuit requires an appreciation for what we think is happening with rates and dollar weakness. The thing I will add for why I think some of this does naturally translate into conversations with like the preferreds that Strategy and Strive have issued is because in some way I see those issuances as another interpretation and execution of Bitcoin denominated yield. So I'll walk you through the math real quick. If you think Bitcoin denominated yield is roughly around 3 to 5%. That's kind of the rate that people generally target when they're earning yield on their Bitcoin in a safe way. You could do it through derivatives trading, you could do it through lending, but it's generally around 3%. And people go, wow, okay, 3%, that is so unexciting. I don't want to risk it. It's just not worth it for me. But if it's Bitcoin denominated, this is the math. If you actually think Bitcoin CAGR is at like 20% over 5 years, that 3% in that 5-year period is actually close to about 40% return of that 3% you've been earning, fiat denominated, versus let's say you were earning 3% for 5 years, compounded, that's about 16%. So that 24% spread in fiat terms comes from Bitcoin denominated yield. Well, what does that 24% over 5 years look like? Well, that kind of looks like the perpetual prefs premium that you're earning relative to the risk-free rate. So the perpetual prefs are actually transforming the physics of Bitcoin's price appreciation by pulling forward some of that yield in like a Bitcoin denominated way. And you're doing it with the safety of not necessarily doing non-custodial things or other things that people are like, oh, it's not worth lending my Bitcoin to Galaxy for 3%, right? And I'd rather do it this way. So I think that's kind of one way I always think about how to appreciate the relative trade-off between what you can earn on Bitcoin adjacent securities versus, otherwise what's available in the traditional securities markets.
Yeah. So I think one way to look at it is, there's a lot of on-chain data you could look at, but there's also, if you just look at the number of adoption, this is another way to look at outside of price, how much Bitcoin utility is growing in the market. So if you think about it, you have hundreds of millions of people around the globe that are now holding it. That was unheard of when most of us got in this space. You have, the growth of Bitcoin companies in general is growing exponential. Like you can have this whole conversation around, is it under pressure right now, which is true, but just in general, it's exponential growth of corporate adoption. Just full stop. And then it's exponential growth of government adoption. Like most of us have been through much harder winters where it wasn't a price conversation, it was a conversation about, are you gonna get regulated out of this country, right? Like that is not the conversation we're having now. We're having a conversation with the largest institutions, the largest governments, the largest companies. Like that did not exist at all. So if you zoom out and look at just the adoption level in general, I lived through the dot-com just explosion. Were we creating value in 1999? Of course. Were we also creating value in 2002? Of course. And in between all of that process, the growth of the internet just continued to grow.
Yeah, and I'd say, going back to your question about the biggest risk, I still think the overarching biggest risk, and I think Jack Dorsey mentioned this, is apathy for Bitcoin. And I think we're all kind of feeling that right now with the AI trade and a lot of risk capital moving to AI and other areas. And so I think it's very on us as an industry to continue to educate, to continue to get out there. You are seeing this great corporate adoption and the institutions coming in, and now's not the time to sit back on that. Now's the time to keep pushing it forward.
And I think one risk area I would say though on the corporate adoption side that I am concerned about is actually the stablecoin risk. So the interesting stat on the stablecoin side is, stablecoin adoption has now eclipsed the growth of Visa and MasterCard combined. That's just wild. Okay, so there's more transaction volume happening digitally on stablecoin outside of the US than any other settlement network in the world. And the reality is 99% of that volume does not exist on the Bitcoin network. So you have all these institutions, you have regulatory clarity now that's happening. But if all of that volume of actual real use of these large companies that are now outclipsing the largest financial service providers are happening off of Bitcoin, that's actually a fundamental concern. And so I think there's a little bit of a mismatch because we have regulatory clarity, we have institutional interest in Bitcoin. It is the largest digital asset in the world, and yet the stablecoin volume is not happening on Bitcoin. So we believe it's really, really important for that volume actually for institutions that have a vested interest in their work that's doing on stablecoin should be on the Bitcoin network.
One fun fact I'll add to that is yesterday, I believe Ethereum was actually placed third as the largest crypto asset by USDT. So actually, it's Bitcoin, USDT, and Ethereum as of yesterday, which I thought was kind of a flippening of a sort.
Yeah, that is really interesting. So we have a couple minutes left. What is one prediction that most people in this room would disagree with that you have?
I have a view that the next wave of adoption for Bitcoin from a flows perspective will really come from the original mission of why Bitcoin's useful, going back to kind of people's desire to find utility for why it exists. I think it will come from sovereigns. And I think it's because when you look at the state of the world right now, you're seeing a lot of the trends converging in this direction. If you think about the genesis of why Bitcoin is useful, it starts with the weaponization of the dollar by OFAC, right? This is clearly the case for why there are use cases for non-American partners to want another store of value that they can transmit freely without having their accounts one day frozen randomly. Then on the other side, you might have heard today, Oman basically said to the US, there's no way we're going to have any chance of opening the Strait of Hormuz without some kind of concession for tolls and fees for this particular bottleneck of the world. Well, that's basically because that's their own choke point of how to actually participate in this global leveraged financial war. So what we're seeing is emergence of choke points, one by financials, one by geographical, that are literally at odds. And what is the solution? It's Bitcoin. The people who are tolling these streets are going to want Bitcoin. And so if you think about that direction, the prisoners of geography meeting the prisoners of fiat, I see the next wave of adoption clearly being driven by those types of flows, and hopefully it'll restore the confidence of why Bitcoin exactly is useful for the use case that we've been talking about for 10 plus years. I feel like we are now accelerating towards that closer than we've ever seen before. So I think it's a little contrarian, but maybe in this room it's not, and I'm excited for it.
Yeah, I think something that's cool that's maybe orthogonal to the sovereign use case is, when you think about government adoption, like there was a lot of conversation around like the strategic, reserve being built and all of these things. I think the biggest driver of that is actually the bottom-up grassroots portion that drives sovereign adoption and drives, these strategic reserves. So if you look at El Salvador, for example, our company, we are one of the only, I think, corporate providers of grants to these things called Bitcoin circular economies. We have a foundation that does that. And these are like small towns and villages, generally in the global south, that are operating 100% in Bitcoin. And what's fascinating about their story is when you hear a story like El Salvador that has a Bitcoin reserve and is driving so much policy adoption, and potentially had a role in how we thought about it in the Genius Act and Clarity Act, et cetera, it didn't actually happen from top-down presidential leadership. It actually started from two kids and a missionary in a small town. Those two kids in a small town then orange-pilled the entire town. That town became useful, completely adopted Bitcoin with nothing else because they had no access to banking services. It then transformed the state. So you can imagine a small town outside of New York transforming the entire city and then the state of New York. And then some politicians saw that and then said, we're going to adopt it as a country. So what happened? You actually saw at the very bottoms up the grassroots movement of a tiny little Bitcoin circular economy transform a country that then created a nation state adoption. So my view is we're going to see more sovereign national adoption, but it'll happen at the grassroots through these Bitcoin circular economies that literally no one is paying attention to.
I'm not sure if this would be contrarian or not, but I actually think as a Bitcoin industry, we're spending way too much time infighting instead of growing the pie. Like, I think it's just, like, Bitcoin's a $1.2 trillion asset. How much is Elon Musk worth now? I think he's worth more than the whole Bitcoin network. Like, what are we doing? Like, this is tiny, tiny. And instead of dedicating your efforts on tearing each other down, and now, like, at the end of the day, it's good to pressure test. It's good to get your truth out there. It's good to really think through some of these things. And there's a lot of innovation happening, which is all great. Some of it may work out, some of it may not. But at the end of the day, the pie is incredibly small, and we all live in a micro ecosystem. And so I would just recommend everyone here to step out, focus on growth, focus on orange pilling more people, because that's really where the adoption happens. It's building in orange people, more people, not trying to tear each other down. So I'll just leave it at that.
Great way to end the panel. Thank you.
face. I wanna.
And get started with the rest of our content for the afternoon. Several more sessions here to get through, starting with our next panel. So please help me welcome to the stage of Roxham Guillaume Baxman. Please help me.
Are we ready? Yeah, looks like we are. So, first, let me introduce you. I'm with David, Curtis, and David. We are here to go through our panel today, which is, and I'm sorry, I need to read the title again, Where Digital Assets Fit and What It Takes to Commit. So, this year, we all know that it was, and I think we all said it already, was a tough year for Bitcoiners, but we are here. And we are brave enough to be on a stage talking about Bitcoin, so that means a lot for us. First, for the ones who don't know them, I'm going to leave a minute introduction starting so you can present to everyone.
David Buttrey, co-founder of Mangrove, and our background, it was primarily building AI technologies for NASA, the Department of Defense, and the US intelligence community, and building AI frameworks for complex systems. Our discovery was in 2019, financial markets are another complex system.
Curtis with Giga Inc. Giga Inc. is our mothership, and what it does is it oversees and gets fed by our core operating business, which will be a big part of today's conversation as well, which is an AI tech-enabled manufacturing company that is disrupting a $115 billion a year industry. And through that, we manufacture windows, doors, facade elements to buildings like you see all around here in New York City and around the country. And what's been positive for us is that through our profits since 2021, we've been able to stack Bitcoin on the balance sheet as a treasury asset.
How's it going, everyone? My name is David Chikansky. We are Quantify Funds, a little bit more TradFi than a lot of the crowd here, but we build hedge fund quality ETFs so far with 3 in the crypto space using portable alpha. So a Bitcoin and gold pair, a stocks and Bitcoin pair, trying to get leverage into TradFi in a unique way in a buy and hold format. Also with some derivative income and volatility harvesting on one side as well. Obviously, everyone in this world cares about how to actually monetize their viewpoint on Bitcoin. So very excited to be here.
Good, thank you, the 3 of you. So I've got the first question, and this is for all to debate a little bit. You've got 3 very different aspects or angles on the same thing. An ETF, an industrial company with BTC Treasury, and an AI platform for wealth. In one sentence each, please. Where does Bitcoin fit in what you do? It is a product, the balance sheet, or the infrastructure? David?
So for us, Bitcoin is one of the assets you can invest in on our platform. And we have 67 digital assets so far listed on the platform. But what we found is in 21 different market regimes of Bitcoin, in 19 of them, buy and hold outperforms most strategies. But in 2 other strategies, or 2 other market regimes, we found hundreds of strategies that actually outperform Bitcoin. So it's an asset class for us.
For us, Bitcoin is a separate but aligned flywheel. So our core operating business and our Bitcoin side are both flywheels operating, pushing each other that are allowing us to have exponential growth and continue the opportunity to grow year over year more and more through operating together in an aligned path.
I'd say for us also an asset class, a store of value. We actually think Bitcoin specifically has characteristics much more aligned with gold than the rest of the cryptocurrency space. And I think especially in this world, especially in the volatility you see, the geopolitical risks, what that's doing to commodity prices, it can never be just one thing. And so we actually take like a diversified approach against currency debasement, Bitcoin being one of the stalwarts, but we're big believers in gold and anything else that can actually like hold its value and has a constraint on its supply.
Yeah, I understand. Being at Roxham is kind of similar mentality. Since you're talking about that, David, you built BDGD on the bet that Bitcoin and gold behave differently from traditional equities, right? What did you see in the correlation data that justified putting them together in a single wrap? And does that thesis still hold today with BTC increasingly correlated to the Nasdaq in risk of?
Yeah, over a 10-year period, Bitcoin and gold have pretty much a zero correlation now. Ironically, at the moment when you wanted to depend on it the most in the last 8 to 10 weeks, or even longer, I guess, since the start of the war, they've been more correlated, and I think that's been a little bit of a random example than the new norm, right? I think gold specifically, the reason why gold sold off during a lot of these geopolitical events was because the economies that have adopted gold the most on their central balance sheets oftentimes were oil importers. So they did the diligent thing and they trimmed the asset that's now a third of their balance sheet that outperformed everything else, and they used it to cover a shortfall. So I actually think what's most ironic is in the last 6 weeks we've seen stocks and Bitcoin correlation actually drop, which is actually something that should be celebrated. I'm a big believer that, obviously interest rates and oil were affected from geopolitical conflicts. And then the other side of it is we had the biggest productivity growth quarter probably in the history of markets, right, of expectations of forward guidance that's coming from AI. And so you have productivity assets and interest-bearing assets. Productivity assets are getting a lot more productive. Interest-bearing assets were paying more interest. It was kind of the perfect storm against a store of value asset, which is why I think it aligns for a bullish future on both.
Thanks. True as well. David, Mangrove joined Bitcoin for corporations talking about the move toward digital credit. For a Treasury and wealth audience, what does digital credit concretely mean today? And what infrastructure is still missing for an RIA or a corporation to use it without turning into a crypto company?
Yeah, from my perspective, at least, Bitcoin, these products today are Bitcoin-backed yield instruments. They're typically in the preferred equities or perpetual preferred equities structure or other structured instruments coming from treasury companies. And I won't go too much into the technical side of things because we've had some panels just wholly on digital credit today, but the sort of biggest macro implication I see from the issuance of these is you're broadening the potential user base through essentially like an awareness campaign of instruments that those that may have not been following digital assets closely are hearing about, especially with STRC and sort of the growth of that. And as an example, we were at the Crypto Convergence Conference in Dallas 2 weeks ago. There were about 200 RIAs in the audience, and we polled how many RIAs had heard of digital credit before. Very few, but after we hosted several nights worth of dinners, I would say 75% of the RIAs at the end of each dinner were interested in exploring it for their clients. So it's another broader use case structure to help grow the pie around Bitcoin.
And why do you think digital credit specifically is what the RIAs are now putting? I mean, why they were ignoring it before is a question.
I think many of the RIAs we've spoken to were often struggling to understand the direct use case of Bitcoin itself or the underlying asset, but the concept of yield is very familiar to them, and that shortens the education gap, which is really one of the biggest issues.
Thank you. Curtis, Giga is maybe the clearest case here, a real traditional business that decided to become a top 5 Bitcoin holder. How is that decision made at the board level? Bitcoin as a benchmark for capital allocation versus simply a treasury reserve, and how do you explain it to a building market client who has nothing to do with crypto?
Yeah, so that's a great question. And we've heard today, and we were just talking about education is a big part of it. But when you talk about it from a corporation standpoint, it starts with personal conviction. You know, at some point, all of us in this room had that feeling of what we wanted to get into Bitcoin for. But when you start talking about it with a corporate level, it becomes a little bit more difficult because you have a board, you have executives, you have a company, numbers of employees. How do you orange pill everybody? And then everybody's going to be orange pilled to a different level if they are, if they're not. And then what is your path? What is your approach? And that's where alignment becomes key. Communication is very important. You need to be aligned as a board. You need to be aligned as executives and have that messaging ready to go. And that also then leads into the second part, which is the governance side, because you need to be aligned on the governance side. You need to know what are your rules, what are your guiding lights, when will you buy, when will you hold, if you're doing other areas, when will you sell, when will you use it to back your loans, what is your approach, what are you looking to do, because as we've heard today, there's so many different tools and resources out there that you could easily get blinded by the next shiny thing. And so as a company, specifically at the board level, you need to be on the same page, and that alignment is key, and that comes from open communication and aligning that to the direction that your business wants to go in. Do you want to be a pure treasury play? In our case, do you want to have a core operating business? If so, how are they going to interact? Are they going to be separate? Are they going to be combined? What tools, what resources? That is key from day one, and it all comes from open communication.
And out of curiosity here, when you are on a traditional corporation like this and you say, hey, let's bet in Bitcoin, what is the average that a corporation would say, yeah, okay, go and do it, 10%, 20%, do 100%, or what was your experience on that?
So I would say at the traditional level, we're talking an infinitesimal percent. But that's why Bitcoin is not traditional. So with us, we were very fortunate that those of us in the executive team did have the personal conviction coming in, and we were all aligned on the personal side and said, well, this makes sense. Why don't we just do this as a company? So for us, we're definitely non-traditional in our approach on the core business side, on the Bitcoin side, and that's where we're seeing the companies that are coming up now, like everybody in this room, we're non-traditional. We're taking that next step because of the education we have and the belief we have, and we're finding how we can work together to make that possible. So for us, it was different.
An easy call. Call. Again, debate. Boom. If you had to give one piece of advice to a CFO or a treasurer watching this from the outside, which I think they are live streaming now, thinking this isn't for my industry, what's the first real non-ideological step to integrate Bitcoin without breaking the business that already works?
I mean, we're a little bit biased, but I would say a store of value on a corporate balance sheet is, in our opinion, just never going to be just one thing, right? Like, it's the input commodities into your business. It's Bitcoin and gold. I think the evolution of corporate balance sheets beyond the dollar is just in its infancy stages, right? It's ironic you're seeing companies do it with Bitcoin and central banks do it with gold and a little bit of Bitcoin, but it's truly going to be a basket, and thinking about it in a percentage sense and allows you to unemotionally take advantage of those divergences. But there's no store of value without volatility in this world. It's certainly not your savings account. So.
Anything, David?
I think from a CFO perspective, realizing more broadly, this is a step change in like technology adoption, and we're coming from a technology background, and it's something that you need to start learning or leaning into now, whether you have a little bit of education, no education, or a lot of education around it, because it's as big of a step change as going from snail mail to email. And if you are not operating with the email technology when that's around, it's going to be very hard to compete with other companies that are. And it's a similar state in terms of looking at Nokia as the iPhone 3 is arriving. where there's just sort of core fundamental differences in terms of the transparency, the distributed ledger, and the proof of work concept that it's very hard to replicate in other formats. So I would just encourage that this is an inevitable wave that's coming, and we're still very early. So the sooner you start trying any of the products in and around Bitcoin and or the underlying asset, just the better off you're going to be in the coming years.
Curtis. Well, you mentioned already, but
yeah, I think one of the big things is, and the panel before the break talked about this too, is showing also to that the financial side as well, how your Bitcoin can work for you. So it's not just so much what is Bitcoin, but what can it do for you, and utilizing that is going to be key, because we would all love to hodl, and we do, but as they mentioned in the previous panel, the battery and holding that energy source and never using it is worthless. So when you're talking to your CFO, you're talking to your finance team, and you're getting them on board, it's what can it do for the company and how can you use it? That's a big factor.
Thank you. And last question again for debating a little bit. On this stage, I mean, everyone on this stage has a commercial reason to be bullish on Bitcoin, right? I guess we all want Bitcoin to go up, otherwise please leave the room. So play the devil's advocate against your own business for a second. What's the strongest argument a skeptical CFO could make against what you are each selling, and why are they wrong?
To start, I would think many CFOs we've spoken to are less familiar with the product, just don't understand the use case. It's a sort of very fundamental mismatch of understanding. And as some panelists spoke earlier, you have the cross-border payments, you have the sort of sovereign and currency protections, you have the transparency, and the evolution of more of these digital credit instruments or other Bitcoin-related products will just open up the potential first use case for CFOs or portfolio managers. And so I think realizing there's not just one first way to get exposure to the asset class. There's a small but growing number of options. And so don't write off the entire asset class because the first one or format factor that it takes when you're presented with it doesn't make sense with your current business operating model or investment mandate.
I think another part to that is where your company is at in your growth cycle. Are you a young company? Are you growing? Are you stable? Are you a startup that needs cash or needs some sort of basis? That's going to be a lot different. You're going to be looking at different resources and assets and different ways to get into it. Are you a company that is more stable, that is looking to park some money to grow longer term, that you want to hodl? Well, okay, now you're going to be looking at different resources and tools. So a lot of it also comes down to where is your company at in its growth cycle and where do you want to go to? Because as we've heard, there's something for everybody out there, and there's new things coming up every day as we hear. And it's not about jumping into the deep end and just going out, buying and self-custodying your own Bitcoin. There's different tools to dip your feet in, to get them wet, and then depending on what level of volatility you're comfortable with or you can as a company be comfortable, that's going to drive you in that direction. And I think that's often where some folks might be a little bit blind to it because there's too much, they're too scared, and they're not familiar with it.
Obviously, our clients are more in the financial advisor and retail space, but I think it's a similar problem of like, what is your risk-off allocation, right? It used to be a broad bond index. That's not it. We all can feel cash in our savings account losing value every single year. And so I think finding the right mix of assets that will protect your revenue streams that will come with some volatility, right? And I think, as you said, your board has to be aligned on that. But whether you're an individual investor, an institution, or a corporation, just recognizing that the one thing that's certainly losing money is that one thing that's not moving in your account, which is cash, and just really expanding your mindset beyond that.
Good. Thank you, the three of you. We have planned some questions. We are done with the questions, so for the last 3 minutes, I'm going to ask you to give your last sentence on especially knowing where we are standing in the market at this moment. What is your view, not price related obviously, but what is your view for the next 6 to 12 months on Bitcoin? What should happen or what will happen for you?
I imagine I won't make any price predictions, but the continued structural level adoption from institutions will keep taking place. The publications from these firms, the distribution through their wealth advisory channels will start to bring Bitcoin more into the mainstream. And really doing these surveys at that RIA conference was just very eye-opening in terms of how far we have to go to keep spreading the word about Bitcoin as an underlying asset or these products around it. And I would suspect that trend will continue to rip out to the sort of next concentric circle out of clients over the next 12 months.
One thing I would say is, and this is just one piece of experience from our side, because we've been through a couple of different cycles as well, it's to not let it become a distraction. Whether you're just formulating your approach, whether you're further into it, whether you're much further into it than others and you felt some of these cycles, is not to let it be a distraction. Yeah, we all have that tendency to pull out our phones every few minutes and take a look and see, is it popping yet? But I do see that we're going to still have some volatility, but I think those of us who've been in a little bit longer know it's okay, it's coming, we're going to get back to it. I think the biggest part, especially for the corporate level, is to not let it be a distraction. Hold strong, hold steady. We're going to rebound. We're going to be jumping back up. I'm not going to give a price prediction, but we're definitely going to be better off than we previously were. We just can't let that blind us from the path that we need to go through.
Yeah, I'll say with no specific evidence behind this, it definitely feels like the hedge fund world is coming together directly against some of these digital asset treasury companies all at the same time right now. And you're seeing it in their prices, you're seeing it in the prices of the preferreds, in the put buying in MicroStrategy yesterday morning, into the lawsuits that seem to be very coordinated. To reframe something I said earlier, we just had this period of massive productivity growth and interest rates being pushed upward from geopolitical risks. These are store value assets without productivity growth and without an interest rate, without some good engineering on top of it. So I think this has kind of been the perfect storm against these store value assets. And I find that the financial advisor space is the have and have-nots with crypto. There's just a very few select groups that are willing to have over a 2% allocation of their client books. And I think I initially expected that the rest of the marketplace would, like dominoes, so okay, I'm a Morgan Stanley advisor, we just launched our own Bitcoin ETF, there's going to be a wave of slow adoption, but I think you're going to really have to see that next price leg up before you start seeing the FOMO from the financial advisor community that's on the sideline right now. But I think that's what can really make it exacerbated, and it seems like the ultimate bearish moment in Bitcoin right now. So knock on wood, hopefully there's not much else that can make it worse.
Great, time is over. So thank you, David, Curtis, and David, and thank you all for being listening here. And yeah, you can contact them everywhere. And thank you.
Thank you guys so much. Great conversation. All right. Well, we are down to our last 5 panels. So thank you again for being here. If you're out in the lobby, once again, invite you to make your way in. I also want to greet our online audience. What's up? Thanks so much for tuning in. We got thousands of people online watching the live stream. These sessions will be recorded as well. You'll be able to pull them up on our YouTube after. Let's keep the good times rolling here with our next panel. This one's a little bit controversial to some people, especially the online audience. We know we've gotten some feedback. So excited for this conversation led by Wyatt O'Rourke from Basilic Financial. Hold the wrapper or hold the asset? Please welcome our panel.
Good afternoon, New York, the capital of capital. It's great to be here. Super appreciative of George and the BFC team for putting on these events. I love these events. Great audience, great topic. great panelists. Why don't we just do quick introductions? Zach, why don't you kick us off?
Yeah, great to be here. Zach Pendle, I run research at Grayscale. Grayscale is the world's largest crypto-dedicated fund manager. We've been around for 13 years, started with a Bitcoin investment product, but now, of course, cover a wide range of other digital assets.
Kristen Mirswa, I'm the head of digital assets for FTSE Russell. We're a London Stock Exchange company.
Ben Workman, I'm the Chief Investment Officer at Strive. At Strive, we're the 7th largest publicly traded company, Treasury of Bitcoin, and we were the 2nd issuer of digital credit. We have our product SATA out there in the market.
I'm Wyatt O'Rourke. I'm the founder of Basilica Financial, or Bitcoin-focused wealth management firm, and Pax Partners. We're a private credit fund that invests in Bitcoin collateralized loans. And we're going to be getting into a lot today, but just kind of like some level setting and a couple of key themes we'll be touching on. It's really the Bitcoinization of finance and deepening Bitcoin capital markets, right? And the Bitcoinization of finance thesis is really about how we build the tools, products, and strategies to get dollars into Bitcoin. And one of the biggest events or biggest benefits of an event like this with this audience is the people on stage and the people in this room are doing this exact same thing. So it's very exciting. And one of the things that the wrappers have really added a lot of value to the marketplace is being able to engineer some of these risk profiles so we can get like these large capital pools into Bitcoin. And as a good Bitcoiner, as a Bitcoin maximalist myself, I think it's important we pay homage to our cypherpunk roots and where we came from. And it's important when you're doing business to do it in the principles, values, and ethos of Bitcoin. But it's my personal opinion that we don't get to hyper Bitcoinization without the finance industry, and we'll be breaking that down. But Zach, I want to start with you because Bitcoin is kind of like dog years, where it's like 10 years pass in like 1 year or whatever. But the ETF is kind of like the first OG wrapper launched in 2024. That was like 2.5 years ago, which is crazy. I think that's crazy. But that really kind of brought Bitcoin into Wall Street light, add a lot of validity to the asset class. Why don't you just kind of take us through where we're at now, how you see us moving forward, and just kind of like some of the history of the ETF wrapper?
Yeah, absolutely. So the first filings for Bitcoin ETFs were in 2013, and they didn't come to market until 2024. So 11 years later, a long battle with regulators. Grayscale took the step during that period to sue the SEC. We won that lawsuit. That's why these products came to market. So as the movie title goes, kind of crypto policy and crypto regulatory topics are one battle after another. So we've been through a lot of those battles, and there are more to come. But fortunately, over the hump on the ETFs. We thought that these products would be extremely popular with investors, and I think that has proven to be the case. And the reason is just they're the easy button for Bitcoin investing. There are lots of ways to buy and hold Bitcoin, and there's no wrong way to do that in my view. But if you buy Bitcoin somewhere else, you need to decide, where am I getting that liquidity and what kind of price am I getting the Bitcoin for? How am I holding that? Is that on an exchange? Is it in self-custody? How am I going to do my taxes? How am I going to do the rights of survival if something happens to me, to my family, inherits the assets in an effective way? Can I borrow against those assets? In the context of proof of stake networks, how do I stake these assets? So there's lots of things that an investor in digital assets and Bitcoin needs to sort out for themselves. Essentially, the ETFs package all those solutions into a single instrument, and they just make it extremely convenient for investors. Institutional liquidity, custody, and all the normal uses of your brokerage accounts or your tax advantage accounts that you have with other securities, you have this with the ETF. So they're not doing anything complicated. Of course, there's lots of interesting things that Strive and others are doing that go well beyond this concept, but the ETFs are designed just to give you efficient, effective, safe, marginable, et cetera, all these things, Bitcoin exposure. They're a very simple instrument, and they've been very popular for that reason. Bringing us to the present, of course, the Bitcoin ETFs have come a long way. On the Bitcoin side, we've seen an expansion of other types of instruments, things like covered call strategies that build onto this concept. And then, of course, many other altcoins. The SEC now uses something called generic listing standards for crypto ETFs. We don't have to go through the lawsuit and the 11-year process to get other products to market. We have a set of generic standards, and so Grayscale and other issuers are broadening our platform beyond Bitcoin to Ethereum and Solana, et cetera, long list of other things. So that sort of brings us to the present. I think wildly successful products, a long time coming. I think an excellent way for any investor to build Bitcoin exposure into a portfolio.
Yeah, well, thank you for your service and fighting the good fight on behalf of the community there, suing the feds. Much respect. Yeah, so I mean, it's really interesting, right? So like you mentioned, the success of that launch, kind of what it did for Bitcoin as an asset class, getting more exposure. People can get more exposure to Bitcoin. Kristen, you guys have a very interesting perspective, and we talked about how some emerging markets are for the first time launching their domestic ETF products. Walk us through kind of what you guys are seeing kind of outside the U.S. If that's going to maybe kickstart a little price action here, more demand for these kind of products worldwide.
Yeah, I'm really happy to share with you guys that as an index provider, we're working with everyone globally, and we're seeing more demand from emerging markets than we ever have before for simple Bitcoin ETFs. And this is just regulatory, right? They've been all wanting to do what the US has been doing, but now their regulatory regimes are opening up. But one of the things that I think is interesting that we were chatting about when you think about Bitcoin, there's no what is the price of Bitcoin? It's more like what did you exchange Bitcoin for, or what rate did you get? And as an index provider, I have hundreds of Bitcoin indices already up and running. And you're like, why so many? Isn't there just one? But they, of course, have different closing hours, the model that you use to fix it, the data inputs. So I'm hearing from a lot of these emerging market asset managers that they want a domestic Bitcoin index. And what that means is they only want us to use data inputs from their region, and they only want data pairs that might be like, if it's Japan, it would be Bitcoin Yen, Bitcoin USDC, and Bitcoin USDT, and that's it. They don't want any other currency pairs to go into that aggregated price. So we're very busy doing these indices right now, but I think that's a strong signal that the rest of the market is coming, and we'll see more pressure or demand on Bitcoin in general.
Yeah, and it's super interesting. I think that's very encouraging. So we kind of have like the basic ETF wrappers. I'm a big believer, keep it simple, stupid. Like I'm a big cold storage guy myself, but arguably the most exciting developments in Bitcoin and finance have been the preferreds, and obviously a hot topic of conversation now. And Ben, you guys at Strive are clearly on the forefront of this, and I kind of want you to help us peer into your guys' thought process of the financial engineering that goes on at Strive. And I don't use that in like a negative context, but I think you guys have really elevated the wrapper game, and maybe you can kind of just touch on how Bitcoin supercharges your balance sheet, the capital structure, the flexibility you guys have over traditional balance sheet or capital structures.
Yeah, and what an interesting week to be having this conversation, huh? Anytime that you launch a new product into the market, that there's going to be a point in time where the market is going to stress test you, right? They're going to test the limits of the product. They're going to test the faith of investors. They're going to see how you respond as a company, as a management team. How does the product respond? And we're in the middle of that right now. So this is a part of this growth process. It's a little interesting because I've never truly considered either of our products through the common equity or through the preferred to be an actual wrapper of Bitcoin. To me, it's a way that we can bring different types of exposures and different type of investment characteristics to investors. So for instance, if you think about the fact that we've got a Bitcoin balance sheet that's got nearly 20,000 Bitcoin on it today, and we've got the amplified exposure, that means that our common equity is going to be highly sensitive to the moves in Bitcoin. So I view it mostly as an enhanced volatility product. That's really attractive to a lot of people that want to take directional bets one way or the other. And what we want is to create the best vehicles for people to express those trades in. So that's what we've done with our common equity. On the other side, there's an acknowledgement that, one, not everybody's found Bitcoin yet. You walk around the streets of New York, you can have the conversation. Most people won't even be able to tell you the issue with the money in their pocket. They've never had the time to stop and think about it. But what we know is that there's always a consistent demand for cash flow. It's a central part of individuals' lives. It's a central part of running a corporation. And so for us to be able to carve off part of the volatility profile of Bitcoin and part of the excess return of Bitcoin and be able to deliver that back to investors in an attractive yield product, I view that as us taking Bitcoin and moving it one step closer to investors where they are today. Right? Instead of waiting for them to come to Bitcoin to find out all of the benefits of an asset that you can self-custody, that you can hold, that you can transact with no intermediary in the process, we all know how powerful that is. Most people haven't started the journey. So if we can bring an attractive product out to the masses that provides them day-to-day utility in their life that's made possible by Bitcoin, to me, that is going to help us bring Bitcoin one step closer to them and help them on that journey, to accelerate that journey, because if the product's good enough for us to issue a product like this into the market, it's probably something that they themselves should want to hold. So that's how we actually see this playing out there in the market, is we have a realization of you have to find the investors where they're at, and that means paying very close attention to what they want. And kind of the trio, if you could really hit the home run in any one of these products, is price stability, right, which is what's being tested right now in the market, high yielding, low volatility, right? Like that's what you're trying to accomplish, and deep liquidity. And when you're trying to do all three, right, that's where the market's got to stress test each one of those. And liquidity right now is the one you're seeing. There's deep liquidity in these products. There has been for a long time. And we think they're just a really unique value proposition that we can make available because we decided to take the step to capitalize our company on Bitcoin, because we can manage the risk as a corporation, right? We can now offer attractive characteristics into the market that it really hasn't seen before.
Well, that's beautifully put, and it's my understanding that SATA, so daily dividend, first ever daily dividend in U.S. security history. Yeah, well, that's pretty cool. How does that play into like these three legs of the bar stool?
So that was a really big unlock. That's one that we're very proud of. And the reason being, if you think about dividend-paying corporations that are out there, only 2% today even pay monthly dividends. You would think in 2026 people would be moving up the frequencies on these because the quarterly dividend really came into play back in 1885. So we still are following a standard practice that was established in the 1800s, which seems crazy. And so being able to unlock daily has a real material impact on how you would expect the security to trade. So if you've got a security that pays one monthly dividend, that means that during that month there's one date where it's truly economically required to hold the security to get the benefit of the dividend. When we changed over to daily, it means that literally every day that market is open, you've got that day as a record date, that day is a next dividend date, and that date is a payment date. So now it becomes economically beneficial to hold that security every single day and not use it to trade in and out of, right? It could become a landing place for capital. Some people may just find the yields attractive enough that they just want to park, moderate duration capital in there and collect those daily dividends. But you're seeing those dividends hit your account every day, and there's something with investors where that's very comforting, and it's something they've also never seen before. Money markets started getting into that. They had the daily accrual, right? And these are not money market products, but the concept of daily really came out there. It was a daily accrual, but it was still paid monthly. And so this is really the first time where you're seeing that benefit in your account every single day. And we think that's a really big unlock. And it's one in capital markets history that was made possible by a Bitcoin company. And I think that's a really cool thing that we can put that feather in our cap, that this is just one more way Bitcoin has changed the financial services industry.
Yeah, no, huge tip of the cap to you and the Strive team. I did tell you guys pioneers here, so that's amazing. And Kristen, one of the things I want to really get your perspective on is just working the indices business. How are you guys thinking about Bitcoin exposure, and what do your clients actually want when push comes to shove?
In terms of how we calculate it, or the wrappers?
Both. So I know we talked about being wrapper agnostic. So it's like, okay, what do they want to see, and how are you guys helping them see that?
Yeah. Well, I actually just want to say, I think it's funny that someone thought this was a controversial panel because I think having multiple wrappers for access is so healthy for any ecosystem. I work at FTSE Russell. Today is Russell Recon Day. It's the day we reconstitute the whole Russell series. And why that series is so well adopted is because we've got futures, options, a lot of ETFs, mutual funds, like all kinds of wrappers working together so you have different instruments to hedge with. So I think it's great that we're seeing DATCO companies and ETF companies, perpetuals, futures, all of that on Bitcoin. And then from the indexer's perspective, like I said, it's really interesting that something as simple as Bitcoin, you could be calculating different rates for Bitcoin depending on the wrapper. I'm going to get really technical and boring for 1 second, but for our derivatives clients, they want us to do a time-weighted model. So as you get closer to 4 o'clock or whenever they're rolling, you want the pricing information to mean more, so we do a 15-minute time-weighted look back. For the ETFs, we use a 1-hour simple average look back, so the market makers can make the market between 3 o'clock and 4 o'clock and have a little bit of room to make some money on their own as well. So I just think it's interesting that this one instrument can demand so many different indices or calculations for all the different wrappers, but they work really well in concert together.
Cool point and explanation, because we're definitely going to get slandered on Twitter because of this title, but it just goes to show, like in real life, people need different sorts of exposure, and that's not a bad thing. And Zach, you kind of alluded this to the beginning. Underlying plumbing to financial markets, and we're really kind of seeing a big developments of derivatives within Bitcoin. So you spent the better part of 2 decades in macroeconomics. How are you seeing the derivatives market in Bitcoin developing, and what does that mean in terms of deepening Bitcoin capital markets and maybe some opportunities that's going to unlock in the future?
Yeah, I'll offer a couple things. Maybe I'll just address the thing about the panel or the wrappers being controversial in some ways. I'd just like to remind people that central banks hold physical gold as a kind of national store of value asset for worst case scenarios on Manhattan. So the wrapper
theoretically
in theory, I've been down there and looked at it myself, so we know that it is there. So the institutions like a Grayscale or anybody else is just there to help people meet their needs, and the wrapper helps people meet their needs, just like the gold in the basement of the New York Fed. And if you want to take your Bitcoin out of the ETF or take your gold out of the basement of the New York Fed, you're okay to do that, as if the service is not something that you need. The derivatives markets are increasingly very rich. There's been a lot of things going on this front, of course. I would say the things that are front of mind for me are perpetual futures and the rise of platforms like Hyperliquid, Bitcoin trading on those types of venues, both in perps and spots. All the things that are happening in options market. You have a very kind of strange shape in options market because so many companies are selling calls, covered calls, and a lot of investors are buying puts for protection. So you have a very skewed options market, but just shows the use of these derivatives for all types of different users. And then maybe I'd add prediction markets, or what Hyperliquid would call outcome markets. I think that these will be very popular for retail speculators, in particular on Bitcoin and other things. So a very rich, to Kristen's point, very rich ecosystem of derivatives. It just speaks to how far Bitcoin has come. And going back to the macroeconomics briefly, I mean, this is why I remain so confident about Bitcoin, even in down markets, even here at 58,000, 59,000. The thing that still goes up and to the right all the time is government debt and deficits, and these are the things that drive demand for these assets in the first place. So I just sort of, whenever we're in a down market, I just remind myself the core reason that we're all here, which is that we're taking huge risks with our fiat currency systems, and we need these other assets like Bitcoin to provide a ballast to portfolios, and whether they're buying in an ETF or through a variable rate preferred
Certainly here. And guys, in our last minute here, I just kind of want to do a rapid fire down the line, starting with you, Ben. Share with the audience one future, maybe hole in the market that you've seen, financial product or opportunity you're excited about in Bitcoin land.
What I've actually had a lot of discussion around is real estate developers or real estate investors that are finding a lot of value in Bitcoin. And, it fits a lot of the principles that they have in their portfolios today. And as they're watching the real estate market inflate, they're looking for a new home for that capital if they have to rotate it into something else, right? When you see the price of real estate rising and you see the affordability of it going down, right, there's a fundamental disconnect out there. And so I've had a significant amount of conversations with fairly large real estate investors that are looking for a place to park that capital if they sell out of a real estate investment, and a lot of them are finding Bitcoin is the place that they want to put it. So I find that very encouraging.
That is neat. I've actually had a couple conversations like that too. That was a good call out. Kristen, how about yourself?
We're also building a lot of indices that are Bitcoin, precious metals, also any of the rare earth commodities all pulled together. So I think that's great because it's saying everyone feels like Bitcoin's a core part of some sort of portfolio. It might be an investment as a store of value, or it might be people are starting to think about it like these other precious metals and rare commodities, and they want it all together. So I think that's also a very positive sign.
Zach?
Maybe I'll close by saying I think truly the institutional adoption of Bitcoin ETFs is only right now getting started. When you think of classic institutional investors, pensions, endowments, insurance, sovereign wealth, there's been a couple that have dipped their toe in, but actually it's a still very narrow list. And we interface with all these types of investors, and those discussions, those allocations are all kind of going through that process now, and they see market prices today as a huge opportunity. These types of allocators, the last thing that they want to do is make a foray into crypto, and then 50% bottom falls out. They see the drawdown, they see the structural adoption trends and the need for these types of assets and portfolios, and so now you're going to see those allocations, I think, over the course of the next 6 to 9 months or so.
Well, thank you guys for sharing your expertise. Let's give them a big round of applause.
Thank you guys. One more time for the panel. Great conversation. Very, very high signal. In fact, the whole day really has been high signal. Hope you guys are enjoying the content. We're going to keep things rolling and shift focus a little bit to politics. Bitcoin on Capitol Hill, moderated by Pierre Richard. Please welcome the panel.
All right. So I've got questions lined up for these gentlemen, but first I want to ask them about maybe the bigger question, which is that when we think about Bitcoin, it's decentralized, it's permissionless. The ethos of Bitcoin is very independent. Some would even say libertarian, and they think it's Bitcoin versus the state. So what are we doing up here on a panel, kind of getting into the weeds on what DC is doing? How do you push back on that cynical and that nihilism about today's politics? So we'll start with Stephen. And feel free to introduce yourself.
Yeah, Stephen Pollock, Signal Ridge Partners. We're a consulting firm, works with Bitcoin businesses. Before that, I was at Bitcoin Policy Institute for a while. And before that, I ran campaigns, state, local, national, all over the country in issue advocacy. So to tee that up, why should we not be cynical? Great one to start with here, Pierre. So I would say I think I am cynical, first of all, and that's why we should be involved. The reason we should be involved in national politics, or we should worry about what's happening with Bitcoin on Capitol Hill, and this is a conversation I've had with tons of people outside of corporate Bitcoin, hardcore Bitcoiners, everyone across the spectrum there. The reality is that if you're not at the table, you're on the damn menu. And so I think we're pretty spoiled right now. I think we're fortunate and there's some people here in this room and the room next to us joining that I think we have to thank for that. However, I think and we can get into this later, we may find out very soon what it's like to be on the other side, and I don't think we're gonna like it very much.
Good afternoon, everybody. Steve Baum, Managing Director at CBiz. I head up the crypto division at CBiz. We're the 7th largest accounting and audit firm in the country. I focus primarily on helping companies get to the public markets that have digital asset businesses. So the question, I'm not in politics, right? So I'm more on the compliance side. But when you talk about the kind of last 15 years of Bitcoin, we look at revolutions, right? And how do revolutions start? And whether it's this technology, blockchain technology, or how the internet started, it's always people pushing for the next level of innovation. And I think when that began, you had this libertarian view of Bitcoin as this free money and something that would be outside the government's control. But then over the last 15 years, I think that the technology became so strong that people started to realize that this type of tech actually is so innovative to be used in financial institutions that it had to have some sort of oversight by government. And that shift has pushed people out of the industry, but also has brought a lot of new faces in. So I think overall it's a good thing because this technology is going to get broader as we kind of see it evolve over the next decade or so.
Paul Tarantino with Byte Federal. We are a Bitcoin-centered fintech platform. We have 2 different divisions. One that is our retail on-ramp through our kiosk network, so Cash for Bitcoin. And then our other, which is payment processing. We just launched the very first US-regulated casino transaction in Vegas with Circa. So we are funding bets in the casino with Bitcoin. To answer your question, I'm probably the least political person on this panel, but I have also been impacted by it directly with our business. So we definitely have some opinions. But I got into Bitcoin because I believed it was a tool to really fix a lot of the problems that we saw with this combination of the political and financial mechanisms of the world. So Bitcoin, from that libertarian perspective, was for us a way to solve or heal what we long perceived as a lot of deep problems within those 2 systems. So the adoption of Bitcoin at the larger scale, both Wall Street and government, is a double-edged sword because you do come, or we came to this with these sort of idealistic goals in mind, and the political process is obviously a negotiation that will continue for some time. And so I think that we sort of struggle with that internally. We want it to be done right, and that fight to get a proper policy crafted it has been challenging and difficult, I think, for all of us to achieve.
Excellent answers. I'll give my own answer, which was my experience with Bitcoin mining in Texas, where we saw legislators who were opposed to Bitcoin mining, and by a process of engagement and education, they actually changed their views. And so as much of the cynicism there is out there about politics, I actually came away with that almost idealistic. Maybe I was in ideal circumstances to have that experience. But now, Stephen, we saw the Genius Act for stablecoins kind of sail through, seemingly, because they want to finance the deficit. So let's get back to cynicism. But it seems like the Clarity Act is kind of stuck in some mud here. The odds online are saying 50-50. Depends which website you check. What's the sentiment like in D.C. around the Clarity Act, and why should we care?
Yeah, big question. First of all, legislation, clarity, ARMA, whatever. I don't know. I don't know what's going to happen. I don't think anybody knows. Maybe somebody out there. If you know what's going to happen, I'd love for you to raise your hand. But I love that it's a coin flip on Kalshi right now. And I think that what I'm more interested in, obviously it'd be great to get something done. I think we have 5 weeks is what they're saying, right? And I think the question behind that is really about the House and the 82 18 odds that we're seeing on the house flipping, because I think where we're at is we're on the cusp. Some would say we're almost there. Some would say we may be there soon, and some would say that we're now, which I would probably say we're there now in the midst of crisis as an industry. As far as, Bitcoin's down. I'm not talking about that. I'm talking about the political realities. And I think we also have a massive opportunity. And so, if you don't mind, unpack that a little bit. The crisis is that, well, first of all, we have Senator Lamas, who's been phenomenal. Senators like Senator Blackburn, Tennessee, let's go. They're about to be gone. And I don't know if any other senators really could have pulled off what they have with clarity, with market structure, because they've been there a long time. They have seasoned staff, and they've sort of danced through the hula hoops to still give this a chance. It's still at 50-50, which is unbelievable, because it really doesn't feel like it should be a 50-50. It feels like it, and so they're going to be gone soon. And I don't think there's any heir apparent. There's people who, we have fans in the Senate and in Congress, but I don't know if we'll ever have another Senator Lamas. I mean, maybe. I hope so, but we may not.
She's a one of a kind.
She's one of a kind, and so that's about to be over with. We're going to lose the House, apparently, right? It's 80% odds the Republicans lose the House, and I say we because the Republicans have been the ones that are supporting us and dragging us all of this forward. And so, we've got a massive opportunity that's about to be, the window's about to be closed. And on the other side of that, you're going to have a Maxine Waters on the House Financial Services Committee, dragging everybody in front of the committee and embarrassing them on national television. So yeah, it's a little bit of a crisis, but I think the opportunity here is that there's still a 20% odds that the Republicans keep the House. And I think that there's a lot that we can do. There's a lot that has been done. Are you guys familiar with the, there's this thing we used to have, I'm from Southwest Missouri, like 30 minutes away at this small high school. This guy grew up, went to school there, his name was Brad Pitt. And we had this thing we called the Brad Pitt rule, which is basically, if you ask someone out on a date and she makes up some reason or says some reason she can't do it, and you're like, I don't know, you're like, well, if you were Brad Pitt, would she say the same thing? And if the answer is no, then she's just not that into you anymore, or not into you at all, right? And I think what we need to realize is, as an industry, we're no longer Brad Pitt. If we ever were, we're not now. And AI is Brad Pitt. And our mining companies are going to AI, and our Bitcoin Policy Institute, which I was at for 4 years, their new summit's about AI, and I think it's fantastic. I think it's smart, it makes sense. But I think we need to realize we're no longer Brad Pitt. And so if you're not Brad Pitt, what do you need to do? You need to figure out how to impress this girl. And so I think at the midterms, we have an opportunity to impress her. And I don't think we're doing enough yet, but we can talk about it more. I don't want to dominate the time, but I think there's some, Nick Begich, for instance, is a fantastic advocate for us in the House, and I think we need to do more to support him. Everyone in this room, anyone out there who hasn't maxed out, them, their wife, their dog, probably needs to do so. And I doubt that we're doing those sorts of things. And anyway. Yeah.
He's representing Alaska, is that right?
Yeah, he's in Alaska. Yeah, but he's essentially solely responsible for ARMA.
Yeah. Tell us what ARMA is and kind of what the impact of that legislation would be for the reserve.
Well, yeah, I mean, U.S. government buying a lot of Bitcoin and holding on to it for 20 years is, that would be phenomenal. I think it's the top of my list. I think it should be the top of most of our list. I think it's a stretch, but I think it's great. So, I think I think Lun, we have advocates in the House side that we need to take care of, and I'm not sure that we're doing it.
Yeah. Now, Paul, let's shift gears to Bitcoin ATMs, not the at-the-market offerings, but the automated teller machines, the hardware. This administration has been pushing back on issues around fraud. Our vice president himself is in charge of this anti-fraud task force. I've seen headlines of fraud busts abroad, like in Thailand or Cambodia, where these call centers are defrauding people, sometimes using Bitcoin ATMs. And so can you kind of get into kind of what the landscape is there and what the legislative and regulatory pitfalls are and what is kind of legitimate in terms of making sure that we go after the bad guys?
Yeah, sure. Thank you. the Bitcoin ATM space, a lot of people may not be aware of this, is been under a misinformation attack that I think is pretty akin to what you went through with mining. I'm not going to sit here and fool anybody that we do have some bad operators in the space, but there are a number of us which we consider best-in-class operators that go way above and beyond what's required by law to legally operate, because we want to stop fraud before it takes place at our ATMs. But the state legislators specifically have been led down a path that the Bitcoin ATM companies themselves are the fraudsters. It's simply not the case. As you mentioned, the vast majority of this high dollar fraud starts in the telecom and voice over IP industry, where you could get a phone number for $100 and very light due diligence. They have a protocol in place called the Stir-Shaken protocol where they're ranking these calls on legitimacy, but the fact of the matter is that the highest rated calls make up 48% of the fraud. So they just don't do enough. And the FCC's filed about $208 million in fines and collected $7,000, so way to go. That being said, that architecture of fraud does not just affect ATMs. There was well over 200 and something billion dollars of fraud last year just in the banking system, all starting from those calls. The ATM industry is about 247 million last year. So we're a very small drop in the bucket of total online fraud. And if you look at this fraud, it's not just hitting the banks, it's also Zelle, PayPal, gift cards, credit card fraud, ACH, wires, you name it. It's across the system, and it's growing at about a pace of about 25% a year because of the AI. So the attack on the Bitcoin ATM industry in specific is really misguided because they don't take the time to understand that not all operators are created equal. We have a number of protocols in place inside our terminal that are sorting out and confusing people that are being coached, so we can find out if they're not reading our terms of service, if they're not properly addressing the fraud questionnaires that we have built into our terminal. And everybody over 60 is getting a live phone call from a trained US customer support staff to specifically verify that they're doing this transaction for their own investment purposes and that they're not being coached or being sent to the ATM in order to make a payment to somebody. That's all on top of full KYC, BSA compliance, AML, SARS, CTRs, on-chain analytics, verifying your wallet, tracking your money after you've bought it. All of this is to say that the ATM bans that are taking place across the United States right now, we have Minnesota is banned, Tennessee is banned, and Tennessee actually made it illegal to actually even own a machine if it's off, right? You can't even have it on your premise even if it's turned off. You can go to jail for that now. And then, we have a bunch of pseudo bans where they've restricted the operational profitability to the point that it just was not profitable to operate. So we have been, like you, through the mining debacle, have been trying to educate lawmakers. We've combined with 2 other operators in the space. We just had a great call with Durbin's staff. We're trying to make sure that they understand there's a right way to do this business so they can preserve access for the 26 million and underbanked Americans that need it. This is the group that's underserved, that suffers most from inflation. That's the primary customer for the ATM industry, and we want to preserve access. So that's crucial that we get in front of these people and we have time to educate them. They're passing laws without understanding the way the network works. They're passing laws without understanding all the protocols that are in place voluntarily in order to prevent fraud. And frankly, we have a much lower rate of fraud taking place on the ATMs because of our protocols than any other part of the financial ecosystem.
All right. So I will continue not answering my phone calls because it's fraud, fraud, fraud.
52.8 billion calls, robocalls last year in the US.
That's crazy. I feel like half of them went to my phone. Steve, all right, let's kind of go on to a rosier topic. Although with the Bitcoin price doing what it is, it's not that rosier. I put on my red tie today because we're down. fair value accounting. So it used to be the case that you could only write Bitcoin down on your balance sheet. Now you can write it up, hypothetically, in the future. That was removing a major obstacle for corporate Bitcoin adoption. What now do you see as kind of the obstacles you're encountering with your practice, or is everything kind of streamlined compared to other assets?
Look, I mean, we'll talk a little bit about accounting, and I could talk about the ATMs, or I could talk about the Clarity Act as well. Obviously, the ASU that got passed a few years ago allows you to now mark-to-market digital assets, all digital assets, including Bitcoin. That was a big change because the financial reporting that you saw public companies, specifically 10Ks, 10Qs, didn't represent the true value of those assets because you would have to drive them down to cost and you wouldn't be able to remark them if the price recovered. It doesn't have that big of an impact overall because most investment vehicles require fair value accounting regardless. So it really didn't have a huge impact except if you were really just a public company that wanted to report digital asset holdings. So we see that change now, simplifies the accounting, but does it really change much? I don't necessarily think so. It just gives a little bit of a better picture of the fair value of those coins. Now, some of the bigger topics probably are around revenue recognition. If you're, taking Bitcoin, doing different strategies, whether it's covered call strategies or if you're mining Bitcoin, they're still dealing with how do we report this properly from a rev rec perspective. And I think there's a lot of diversity in practice that continues to be there with digital asset transactions that generate revenue or income streams. It's an area we see typically that the SEC is pretty involved in, as well as the PCAOB, which is the oversight committee for public accounting firms.
All right. Now we're running short on time, so I'm going to try to kind of provide a wrap-up question. Stephen, how should people really get engaged? We've got these midterms coming up. The primaries were very interesting in their results. We could lose the House. What do you think the Bitcoin community should be doing more of and less of as they engage with politics?
Sure. I think it's simple. Double down, triple down on your winners. So Nick Begich, like I said before, Zach Nunn, max out to these guys. Call up the NRCC. Say, hey, put me in, coach. As an industry, or you individually, we should call the NRCC and say, what can we do to help? And then, engage, grassroots, ground and pound. Top down's not going to work. We're going to have to, really roll up our sleeves and do what many have done before us and learn what it's like to really engage like at a local, state level, congressional district level in the upcoming midterms.
Yeah, and that's something I've seen in Texas is that we've got the Texas Blockchain Council, which has been really effective in engaging at the state level. So I'd also encourage people to find their tribe, find the people around them that are working on these issues. And Paul, do you think the Bitcoin ATM kind of outlook, is that going to be an opportunity to orange pill more politicians, or at this point is it really just damage control?
It's a little bit of both. The educational process through the meetings that we're having with the state lawmakers has really lit the light bulb for a lot of people, right? It's sort of split. It's those that are not taking the time to understand, and then the others that really dig into our fraud protocols, that instantly a light goes off and we commonly hear, how come I haven't heard of this before? And then they want to share it. So we are having traction in regards to that educational process, both stopping further damage and also they're now starting to think like, I can re-implement new legislation in the future that addresses this in a way that's pro-consumer and pro-business and eliminates fraud. So I do think we're having a good impact. I'll just leave you all with this. If you're interested, you can go to bytefederal.com/fraud-prevention. You can see the architecture of scams that affects the entire financial industry and exactly what we're doing to prevent it. You can also find a petition there that you can sign to preserve access to Bitcoin ATMs for people that so desire it. So yeah, I guess I'll leave it there.
Great. Well, thank you to our panelists, and thank you to the Bitcoin for Corporations team for organizing this symposium. So, yeah, well, also, I want to make a shout out for the Bitcoin for Corporations show. We've got a podcast and YouTube that everyone should go check out and subscribe, including some conversation with Paul on this topic. So, thank you all, and have a great afternoon.
Thanks, Pierre.
Let's give it up one more time for our panel. Thank you guys. Great conversation. Fascinating stuff. I think I get the other half of the spam calls. Pierre gets one half. The other comes to me. Hey, we are close to the end here. We got 3 sessions left. If you are out in the lobby, I would once again invite you to join us here inside the stage area for our final 3 talks. Again, I want to shout out the people watching online. Thanks so much for tuning in. These sessions are being recorded, and we will have them up on our YouTube page afterwards. All right, we're going to pivot back to digital credit now with Mason Ford from Melius hosting a panel on digital credit, the foundation for what's next. Please.
I look a lot like Alan in my photo. Hello, everybody, and thank you so much for joining us in this late afternoon session. My name is Mason Ford, and I'm the Director of Bitcoin Strategy at Melius. I was also a founding member of True North, which was acquired by Strive. And today we're going to be speaking on the the topic of the week, of the year, digital credit, and the foundation for what's next. And I'm here with 3 very knowledgeable gentlemen who are in different parts of the industry. So, gentlemen, if you will, can you just introduce yourself, tell me who you're with and why you're here today?
Sure. Well, great to have me on the panel with you. King Hui, founder and CEO of Treasury. We're a Netherlands-based Bitcoin Treasury company. Did a round last year of about 150 million, backed by Nakamoto and the Winklevoss twins. Looking for a listing and becoming the first European one on the main exchange. My background is in credit. I've been mainly in distress for a long time, so this is a space that's close to my heart.
My name's Owen Fraser-Green. I'm the CTO of MNAV. We make the terminal for the Bitcoin Treasury era. So we track all the Treasury companies and price the premium discount each one trades at.
Hello, Rajiv Bamra. I oversee the global strategy and operations for what we call digital economy, with a mandate to try and connect what we've been doing in the conventional space for over 116 years and bring that expertise to the digital finance space, where we are now trying to identify credit-relevant digital risks and apply the credit fundamentals to then publish our credit opinions for novel assets, some of which I will mention during our conversation today. Nice to be here.
Awesome. So for the first question, when we say digital credit, what are we actually describing, and why is it becoming an important part of Bitcoin's capital market right now? And maybe start with you, King.
Sure. I mean, if you look at strategy, which obviously has developed the whole space for us, they've gone through this evolution of credit instruments, starting with margin loans, which were a great instrument in 2022, then convertibles, and then trying a number of different pref securities, really ending up with Strive, which obviously Sila calls his iPhone moment. And at its core, it's basically a Bitcoin treasury company has a pristine asset on the balance sheet, Bitcoin, and issuing credit against it. I do have to say that there are clearly a couple of, call it, definitions which are somewhat hybrid, because when you say digital credit, the pref securities are technically an equity and they pay a dividend, which is not the feature of a credit instrument. So I think there is some of that probably also in the market leads to sometimes a bit of confusion, call it. But as we're developing the space, I think that's key to clarify some of those things. But clearly, why is it important? Because it allows essentially growth of the ecosystem, and for credit investors who have a different risk profile to access in a way Bitcoin, and for those dollars to go into Bitcoin.
And I think yeah, if I could just add, I think they're particularly relevant now, right? Because as MNAVs have been shrinking, so the premiums are getting compressed. The ATM isn't working anymore, so just issuing more equity to raise money isn't working. So digital credit is a way then to raise it another way.
Rajiv?
I can share and I agree with both these definitions, but I think I have two definitions. One is, of course, the usual one. For us, digital credit is where institutional debt is being settled on chain, which is happening a lot. But I think the definition that would be more relevant for the theme of this event and conference is digital credit would be debt where an unbacked crypto like Bitcoin is literally doing all the work as collateral, or as an economic exposure on the balance sheet. And it's important to understand how these two different types of definitions are recently starting to integrate with each other in a way where Bitcoin is being used as collateral for more institutional kind of assets. And one of them is the recent example where Moody's did assess and rate the Bitcoin-backed muni bond out of New Hampshire. And it's important to highlight that on one side you have this highly volatile speculative asset like a Bitcoin, and then on the other side you have this most conservative vertical in the financial space, muni markets, and how they both have come together in this issuance where the structure is what was underwritten, not really the collateral, and the over-collateralization of Bitcoin with proper triggers and liquidity triggers put into place, thereby offering the relevancy and the rigor of the institutional finance space, allowing Bitcoin to become more institutional. And that is one kind of an example, along with a lot of other digital asset treasuries, where Bitcoin is being bought and held on the balance sheets, and the treasury strategy is the digital asset treasury strategy is about finding ways to generate yield and liquidity using that static asset on their balance sheet, which is sitting in a cold wallet somewhere. So I think the strategies are evolving as well, and as more and more institutional and crypto worlds start talking with each other, maybe Bitcoin as a collateral, that will lead to more and more digital credit being used as institutional capital, and also allocation of capital in the institutional space using crypto assets.
That's a perfect segue into our next question, which is really about who is digital credit for today, and where is it going to go in the future? Is it primarily a way for Bitcoin native investors to seek income, or a bridge for more traditional institutional investors who want exposure to Bitcoin-linked economics without taking on the full volatility, although recently we've seen quite a bit of volatility?
I was just going to say, I think both, really, and I guess that's the point. I mean, I think for Bitcoin natives, they're getting an income. They're actually getting something, and not without actually having to sell any sats. They're still betting on the power law holds, like the power law similar to what we saw in the keynote this morning from, like with the 200-week moving average and those bands. We're betting on that the price is going to at least stay within those bands, but with reducing volatility, right? So we're basically placing a bet that the price is broadly going to go up, but we're not going to suffer that same volatility as if we were following Bitcoin directly. And I think for the institutions, then they're getting some Bitcoin exposure, but again, not at the crazy kind of volatility that would otherwise scare them.
King?
Yeah, maybe to add, obviously the yields being offered by, for instance, Stretch and SEDA are much, much higher than you can get in traditional financial fixed income instruments. So for institutional fixed income investors that are yield hungry, I mean, clearly you have a very low rate environment in Asia, in Japan, but also in Europe, it is an attractive instrument. So you got to have an institutional investor that's comfortable with that exposure and that risk, but also looking for a higher yield. And I agree, at the same time, it is also for retail a large instrument. And I like to think that's a combination of existing called investors that already have exposure to Bitcoin, but maybe also getting some new ones in that want a lower risk profile, and maybe over time graduate to also owning Bitcoin outright or treasury companies outright.
My take would be two types of audiences, and I think they were both covered. One is, of course, the Bitcoin native audience looking for capital efficiency, which they get if they try to find alternative ways to generate yield, which King said. And the other one, which was mentioned earlier, is the institutional side, where they get exposure or they can invest in Bitcoin without directly holding spot BTC or even getting exposed to the direct volatility of the Bitcoin as an asset. So they would rather prefer doing that, which writes off the risk, but they still have access to the Bitcoin. So absolutely agree with both those points. And from a credit perspective, I think both those aspects are very important to look into. Of course, for us as a credit rating agency, we look at the institutional aspect more than the blockchain, the Bitcoin native one. But how the Bitcoin native audience or the exposure impacts the institutional side is equally important now.
It was reported in the last strategy earning calls that I believe 80% of Stretch holders are retail. And the question that came to mind for me is, what is it going to take for larger pools of capital, institutions, to really dive into digital credit head first in a serious way? Is that track records? Is it ratings? Is it standardization, liquidity, disclosures, education? What is it going to take?
Go ahead. Maybe quick comment, thank you. So I think it's a combination. Certainly all the elements that you mentioned are very important. We've clearly seen some stress in the ecosystem in the last week, so cash reserves will be important, track record, how this develops. But I think at a broader level that this turns into an asset class, because once it becomes an asset class, it becomes unavoidable to invest in. At the moment, it's really two products, right? Again, Stretch and SEDA. But the moment you have an asset class and you have a number of swaps on it, derivatives, people can trade the curve, different issuers, currencies, then it becomes really, really investable for a very large pool of capital. Even though 10 billion is fantastic for a Stretch, it's obviously still quite small in the whole income scene. So I think to me, we're still the first innings of this asset class developing, literally a year old really, and we need to build it in that sense.
I was going to say all of that, I agree, but if I were to rank them, it first would be standardization, which I think is very important and missing in the digital finance space across the board, but also in the crypto world, like Bitcoin and other unbacked cryptocurrencies. And the way and we as a credit rating agency think that credit ratings can standardize some aspects of the ecosystem, because a lot of credit committee discussions at institutions are driven by the credit assessments of the assets that need to be allocated. And that's why we think if we are able to somehow integrate with whatever blockchain the assets are being issued and be able to provide credit intelligence directly embedded into the asset or on the blockchain itself, that will solve a lot of these decision-making issues that probably some institutions are seeing when it comes to allocating capital in the digital space. And we are probably currently the only one that are able to integrate with Canton Network, Solana, and we are scaling that because of that very aspect. But also, I think what is important is the lack of history right now in the space. And what I mean by that, the track record, besides everything that you listed, is because the digital credit has not yet seen a full maturity cycle yet. Because it is under stressful situations that the true test of the market really would happen, and that has not happened yet. So as we see digital credit evolve and that maturity of the assets and assessments with credit associated with them and the capital being allocated and how under stressful situations they stand, that test is going to be the real driver or the real solution to then understand what kind of digital risks that we were looking at and should be looked at in addition to what we have, and what other guardrails and frameworks need to be built in order to avoid those kind of situations which probably happen in the market. So that one track record is also another piece that is very important and is currently missing, but that will only happen over time and can't be just made up because we need one.
The stressful situation, I'm not sure if I can take another one like the one we've been having for the last week. I think also, I would add to both your points there, also education, right? We're seeing half the market can't even distinguish these things between stable coins or Bitcoin proxies. So we're trying to help with that, to help educate the market, explain what these instruments are, how they work, provide tools, simulators, so you can sort of simulate what will happen according to different events of the company that's backing them and so on.
Amazing. Going back to the idea of risk, how should investors be thinking about the risks of these instruments, both on the Bitcoin side and the issuer side? What are the most important things that they need to understand and evaluate before potentially investing?
I would begin with coverage, right? So can the issuer, do they have the ability to pay the dividends? What are their fiat reserves like? Their Bitcoin reserves, if they have to go for that. If they start eating into their Bitcoin reserves, what's going to happen? Do they have an operating business that can support the dividends? So yeah, finding out like the financials of the company and their ability to cover. I mean, when you're buying, say, MSDR, you're buying an equity in a treasury company, you're betting that Bitcoin is going to go up. That's basically what your bet is about. When you're buying Stretch, then you're betting that strategy won't fail, right? So long as the company manages to keep going and it can serve its dividends, then you're good.
I mean, from a credit risk perspective, I think one fundamental doesn't change is the quality of the assets and the segregation of those assets. In a bank remote account as well, that's very important. And the safest way to look at how the structure of the asset is then built on top of that. The second most important part is the legal enforceability that needs to be linked to the token version or the crypto version of the asset as well. So if it's an unbacked crypto like Bitcoin, it's also important that if you are currently holding a claim to a specific Bitcoin or a spot BTC or something else, does that claim actually stand in court, or you can assert it in a court of law, and that's really not been tested either. So the legal enforceability from a credit view is very important. And then of course governance mechanisms, the new mint and burn mechanisms, smart contract controls and designs, and the other technology risk, platform resiliency, the regulatory aspect, everything comes into play with that. But those are some risks that need to be evaluated from a digital credit perspective. And of course, I'm talking from an institutional debt, but that would also apply to a more Bitcoin native treasury or an asset class where we have to look at the collateral aspect and the legal enforceability aspect for sure.
Maybe one thing to add is if you look at digital credit compared to gold standard credit, TradFi credit, obviously the big difference is the volatility of the underlying asset class. And I think most of the digital credit issuers so far are also sized correctly, right? They have very low leverage, 10, 20% at the current environment, which really allows for a big drawdown, right? So I think that inherent volatility in Bitcoin is important to take into account for if you think about risk as a potential investor, and how that stacks up against the capital structure.
Also, in the earnings call, it was pretty clear that Strategy is thinking about the potential products that could be built on top of Stretch or the other preferreds. In your mind, what are the opportunities here, and what do you think will be successfully built on top of stretch or SATA? What opportunities are here?
Yeah, I have to kick it off. I think there's always the two ways. There's a TradFi way and there's a DeFi way. DeFi is always very quick to develop, which is great. So we've seen certainly two issuers on top of Stretch. And that gives an easy tokenized access to Stretch. Then obviously there's a levered version of that. So it's almost like called the CDO or CDO squared maybe even, where they strip the coupons in a senior and a sub piece. So I think, as with always these things, it's very important to structure them in a way that can withstand different shocks. And we see some of them right now, so it's a good test. And certainly, I think that ecosystem will flourish because it's a very solid underlying asset base. If they're well structured, it could really grow. And again, continuous stripping, it's all about creating a curve, right? Creating stripping again, being able to allow different risk preferences for different investors.
I guess we'll judge the candidates. I'm not really sure what products will come next, but I mean, in terms of how we'll judge those, I'm going to be looking at, do they provide more transparency or liquidity versus just leverage? And I'm a little bit wary of just stacking leverage because I kind of feel like these digital credit instruments, I mean, they are like deleveraging instruments in themselves, like compared with pure Bitcoin or Treasury. I think most of all, I just want to see things that bring broader access, right? So getting inclusions in indices, ETF wrappers, those kinds of vehicles that will get broader access, basically.
I have nothing to add on this. I agree.
Well, we only have 2 minutes left, so maybe we could wrap up here. This conversation is about digital credit and the frontier. And let's say 5 years from now, we're at this conference and we're having the same conversation and we look back. What had happened in those 5 years in order for us to say, yeah, digital credit was the frontier, it was the future, it was the future?
I hope we'll be here, and there's a lot of width and depth, right? So lots more issuers, currencies, maturities, a whole, as I said, a whole curve you can trade, but also depth, so much deeper liquidity, much bigger size, potentially some different structured products on top of that. So really, like I think we're good at in general in the space, is taking the best of traditional finance and putting it on on digital assets, with hopefully again with the best practices and avoiding some of the pitfalls.
And I guess, I mean, all of that, and I guess if basically it stops being a crypto story and more like a fixed income story, right? Then that'll truly be success. When it basically becomes boring, essentially, you've got an institutional allocator sitting there at their terminal comparing digital credit instrument with a corporate bond on the same screen. Like, that's when we've really succeeded.
In my view, a success in 5 years would be where we are looking at capital markets with embedded credit assessments or credit intelligence, and crypto-backed institutional structures are not looked at historical milestones, but any ordinary issuance in the markets where anybody, retail or institutional investors, are already aware of the risks and are investing without having to think twice or thrice into that aspect. And I hope we reach that point in 5 years.
Awesome. Thank you guys so much. Please give them a round of applause.
Sorry about that. Just out there trying to encourage people to come in for these last two sessions. Hope you're all enjoying the day. I know it's been a lot of great conversations, a lot to take in. We got two more sessions for you, and you're not going to want to miss these last two conversations. First up, we have Barclays, BlackRock, BitGo, and Bitcoin, hosted by David Bailey, CEO of Nakamoto. Please help me welcome to the stage our next panel.
Hello, hello. I know all of y'all are excited for our esteemed panel today, and I think when people see my good looks up on the TV screen, maybe we'll have some more people come and join the audience here. So, but I am very happy to have this group on stage. And to kick us off, I first wanted to start with the question of, there's kind of three different pieces here. There's the asset manager, there's the investment bank, there's the custody provider. And for the past, I don't know how many years, I think ever since I've been in Bitcoin, people have been saying the institutions are coming, the institutions are coming. And it feels like the three of you represent the institutional stack of Bitcoin. So my first question would be, what are the institutions waiting on at this point in time in order to enter our market and our industry?
I'll go first. So I'm Chen. I'm the Chief Revenue Officer at BitGo. We are one of the world's largest infra companies for everything digital assets related. Been with the company for about 6.5 years, so seeing a lot. In terms of answering your question, I think it hinges a lot on the passing of Clarity. Clarity Act needs to go through. We have midterms coming up in November. Who knows what's going to happen after November? So we have only a few months between now and then before Congress goes into recess, and that thing needs to be passed. We are obviously in conversations with many, many banks all around the world here in the US and most areas around the world. And here in the US specifically, there's a number of banks that has a bunch of folks queued up. They have a plan ready to go, do a lot of tokenization work on chain. It hinges on Clarity. Around the world, what's interesting is the regulators, especially in the larger tier 1 countries, they look up to the US for guidance. Whatever we do here in the US will get propagated around the world. And if we're able to get Clarity through before the midterms, it's going to unlock a lot of business around the world as well. The last thing I have to say is Brian Armstrong, man, like it was going to go through a couple months back. It's all public information. And the guy and his army of lobbyists in Washington, D.C. did not like the couple of lines that they had in that version of the act and pulled the strings and pulled it off. So I'm very disappointed at what happened a few months back. Hopefully we can regroup and get this thing through as soon as possible.
So maybe I'll jump in here. Definitely agree with those comments. I would say from our side in investment banking and bringing new product to market, new issue, it's certainly supply. Like we need more supply. We need more people in the good parts of the environment being innovative and hitting the scale that's required for those institutions to be able to buy into that, both on the common equity side as well as digital credit. The easiest way to play that, if you didn't have scale previously, were converts. And we've seen a lot of people do that, including yourselves, right? But I think that the superior product is certainly digital credit and the perpetual preferred product because it's better asset liability matching. It just has the carry trade that's affiliated with it. It makes sense, right? And it's defensible in terms of your balance sheet over time. There's a lot of debate about that right now, and certainly strategy, having a mixed balance sheet is clouding the dialogue around that specific situation. I would say if you think about, okay, what's holding institutions back besides availability of investable issuers, right? Which is a real, there's not enough, right? Strategy, we did 5 prefs in 1 year, effectively, for them. And a lot of institutions got excited about it. Institutions were there and looked at the first one, maybe turned it down, came into the second one because it was so successful. And we kind of built on that success over time leading up to Stretch. There's still fundamental constraints, though, that exist, like lack of ratings. Lack of ratings takes a ton of institutions off the table. People talk about like huge pockets of capital in insurance and asset managers. Well, they're still antiquated with respect to how they look at their investment thresholds. And if you can be put into buckets that mean love it, understand it, but can't do it because you don't have a rating. And we tried to work with Saylor and team and everyone else to break down that wall back in 2005, but it was just not possible. So I think there's some structural constraints that still exist within these asset managers, both in terms of accepting Bitcoin as an asset class, as true collateral. There are things like ratings and other areas where we're working hard. The regulators, I mean, that's the one thing that's moved in our favor, absolutely. So that's been extremely helpful.
Great comments. I would just add, and I think it's really interesting that we got grouped by the first letter of our company names, because I actually think that introduces like a nice little mix of perspectives to the dialogue. But obviously, BlackRock's a large asset manager. We manage $0 of digital assets for clients as recently as 2-3 years ago, and now we manage 130. Maybe it's lower. Got to check the screens. Right, but the largest product that we have is, of course, the iShares Bitcoin Trust IBIT, which was launched in early 2024. When it was launched, the rough demand was roughly 80% retail and 20% institutional. And over time, if you think about it, come into today, it's become roughly 50-50. So I would say the institutional adoption has actually been increasing. It's great progress. Obviously, we're in the early top of the first inning. There's a lot more work to do. And some of that is a combination of regulatory clarity as well as infrastructure build out. And they're kind of hand in hand, right? To echo Chen's comments, I think more regulatory clarity is going to be what drives the progress from linear to exponential. Even with a delay to that, which would not be good, I think the adoption rate and the growth continues, just at a more linear-like rate. Because a lot of things need to be built in terms of custody, in terms of wallets, right? A lot of people use IBIT because the ETF wrapper is actually easier and more familiar and more plug and play. But all the folks that we speak with in the ecosystem, whether they're crypto native or TradFi, are increasingly building for this future. So it does feel inevitable. It does feel like it's coming. I think the only question is whether that pace that we get there is linear or exponential.
So I want to start with the first question for you, Will. You just launched a new ETF. Congratulations on that. There is some level of competition between, let's say, the role that Treasury companies and DATs play in the capital markets ecosystem, and whether options chains play, and et cetera, and the products that you are launching. How do you all think about the interplay between launching new wrappers and competing with the Treasury companies that are out there in the ecosystem versus working cooperatively with them?
Yeah, absolutely. Thank you for bringing that up. So we launched our BitA ETF, which is a Bitcoin covered rights option ETF last week. Anything that BlackRock launches, we do because of client feedback. We're a very client-centric, client-led firm. And one of the things that clients have articulated is, I am interested in Bitcoin, but I sure would love some way to generate income, and I would like some sort of downside protection. And we can wrap it into one for me, that would be great, right? So I would say completely different products and completely different lanes than what a lot of the DATs have been issuing. Also, BitA, I think we have seen a lot of success in its first week. We're sitting at $30 million of AUM, right? So if we can ever even get close to some of the other credit products, we'll be very proud of that. But again, I think it's just an evolution in the market structure for Bitcoin, right? From the very early days where it had no derivatives to then obviously the early days of perps, and then cleared options, and then the perps really adopting, and then all the ETPs launching in early 24, and then the options, and now having these other maturing things are just ways where that market structure gets more mature and gives you more options, right, for others to come in and build different types of product. Volatility on Bitcoin used to be habitually above 100% realized, And today it's kind of down to this kind of 40 to 60, hovering around 50% range. And I see that as progress, right? I see that as a sign that the ecosystem is maturing and allowing the traditional institutions to come and say, okay, this is an asset that we can work with and create more products and create more creative ways to give clients what they want.
So I want to come back to that topic in a minute, but Lee, I wanted to talk to you about STRC, and I think that that's like the topic du jour of the moment. You know, you worked with Strategy to help design that product. You know, we had a discussion last night about it. You know, now that we're getting into what I would call the edge cases of the product, like the product in, you know, the non-normal circumstances, how would you conceptualize or think about the key mechanics of that product and what matters to the market? And what would be your advice to treasury companies, several of whom are here that I know are working on pref products, whether or not they've been announced, on how to navigate the uncertainty of the current moment?
Thanks for the easy question.
Yeah, it's a softball.
Okay, so I've got my own opinions. Listen, I do think it's a groundbreaking product. It is an iPhone moment. I've talked about it before. I know Saylor is passionate about the product, but as with all new products, you just don't know what to expect as the product matures, and that is not a mature product. Let's be totally clear. I mean, it's, you know, maturity in financial markets takes time, and you need to go through these events. You need to be tested. I would tell you that we do stay in very close communication with them and Strive. We also help with SETA. We felt really good coming out of the Iran conflict that both of those securities did exactly what we would hope them to do. They were a safe haven, they were yield, they went to par, above, the ATMs issuing, et cetera. You know, and the yields made sense, I think, just still given the early nature of the issuers, less so Strategy, obviously. But you know, I think that Strive is a good example because you can look at the leverage and amplification on a smaller company like that and still see it hold in nicely. That's working. So it was working. What we've seen here is there are other structural factors that are playing into why it's trading down below 80. I mean, look, in the mid-80s, I mean, we IPO'd these things at 80, 85, 90, whatever it might be. So could it go back down to the original IPO price? Of course. I mean, IPOs do that all the time. I mean, we're seeing SpaceX broke, right? So there are factors that could lead you down. But I think, unfortunately, we've hit so many people so quickly had put leverage on the instruments, and/or you got retail buying it on margin. And I don't think retail fully understands the product. So we've got some other issues that are forcing us to go below 80, and it's you know, it's unfortunate, but it's a learning experience from my standpoint. And I do think that, you know, we're all hopeful that Michael and his team will come out pretty soon. They'll have an 8K on Monday with a very strong message about, you know, confidence. I mean, this is not a credit problem, and we talked about this last night. This is not a credit problem. And by the way, taking the yield to 15% or 16% also is not going to get it to trade to par. This is just a structural trade-off and test the security. And everyone needs to take a deep breath and sit down, and Michael needs to come up and say, listen, this is not a credit problem. We have a fortress balance sheet, right? Sure, the converts are coming due, but, you know, I'm here to tell you as Barclays, we can refinance those converts tomorrow. I mean, our hedge fund clients that technically priced converts would love to come in at 85 bucks on the stock price right now and restrike a convert. That's not a problem. The put, you know, all that kind of stuff's not an issue. You can refi all the convert debt, and Michael can come out and say all of this. He could choose to do other things too, right? I mean, he's raising cash. You saw in the last 8K last week that he actually sold equity. He could, you know, who knows what he's doing? We'll find out on Monday. He could be selling cash. He could be doing other things, right? And he could raise cash. And they could also, I mean, look, the concept of a buyback is a very common concept in all other areas and products. It's just for perpetual stock, because it's such a novel, new product, has not been rolled out. And so, you know, a buyback is also a very logical way to support a security like this. By the way, it's not a bad financial trade to be buying it back at 75 when you issued it at 100 and then reissue it at 100 3 months from now, right? But I think specifically, I don't think it's buybacks that way as opportunistic and financial engineering. I just think you're supporting a new security that's out there, and it's going to experience some bumps in the road. And you need to know, as a Treasury, when is it moving in a zone where we could hit a leverage trigger? Don't want to go there. We went there. So I think that we should take this experience and say, this is not a problem. There's structural dynamics at play. And I think the learning experience going forward is, do you have other tools in your toolkit as the issuer, Strive or Strategy or future issuers, that will allow you to structurally support that security in these periods of uncertainty?
If there's one great thing you can count on from the crypto market, is that if you design any product and you draw a line of do not cross this line, guarantee that
we're going to cross it.
Right?
We're going to definitely cross it.
So Chen, I want to ask you in a different direction. Y'all have been custodying Bitcoin for a long time. Y'all are dealing not only with the wrappers of Bitcoin, like BlackRock or different ETFs, but you're dealing directly with the corporate treasury teams that are holding Bitcoin directly with you. What has had more success in terms of corporate adoption, going through wrappers or holding it directly? And what's the biggest hurdle you see with getting someone to actually squeeze the trigger and put 2, 3, 5% of their treasury into Bitcoin?
We have a very diverse set of clients. We do work with a lot of DATs. We do work with ETFs. And we do work with a number of OG Bitcoin hodlers. We're talking like 2010, 2011, 2012 folks that have kept Bitcoin with us for a very, very long time. There's also this cohort of people, the wealthiest family offices in a lot of the major countries around the world. They're waking up to this asset class and they're looking at options. I have to say, one of our competitors actually is IBIT. There's a number of folks thinking about what they can do with the Bitcoin they currently have at BitGo. And to be very frank, we had some customers go the other way, meaning they're taking it out of BitGo, they're moving it over into his product, and it's unfortunately going to Coinbase, I believe, underneath. The thing I want to stress about this entire thing is fundamentally, Bitcoin is a bearer asset. You lose the keys, you're done. And maybe I shouldn't say this on stage, but having Coinbase have, 60, 70, 80% of all the Bitcoin floating around in the traditional financial space, it's frankly dangerous and not responsible. So you should look at other custodians. There's plenty of other custodians floating around, and diversify where all the Bitcoin is currently being held. If Coinbase messes up, we're done. And we cannot have that, fundamentally.
We're all friends.
A powerful statement. I mean, to BitGo's kudos. I don't know of another custodian that's been around as long as y'all and Coinbase that has the track record y'all have. So, I want to kind of end on this question, which is probably the number one question I get as a non-capital markets person. I'm a Bitcoiner, putting on a costume of a suit to go to an institutional finance event. But the everyday Bitcoiner tells me BlackRock, Barclays, maybe less so BitGo, but these are the firms that Bitcoin was created to destroy. We don't want these traditional financial firms entering into the Bitcoin market. They are domesticating Bitcoin. What would be your response to that?
Yeah, I'll just say a few things, right? I think number one, we repeat this with every opportunity we get, just to set the record straight that we don't own the Bitcoins, right? We are a provider of a wrapper so that folks who, frankly can't even open like OpenAI or adopt any of this new technology can have exposure to something that they have been educated on and are excited to participate in. So we kind of see our role as being able to bring more people into the philosophy, the belief, the asset, the growth of Bitcoin, right? Now, the fact that they're all concentrated into a single wrapper is one question, but again, if you look at the number of holders on IBIT, there's more than 1,300 that report on the 13F, right? And for many of them, they represent thousands of other individual holders. When a retirement or a pension or a foundation holds IBIT, they're holding that exposure on behalf of a lot of people. So we kind of view it as an opportunity to allow more people to come into the ecosystem, and we don't view our role as someone that's kind of trying to centralize what that represents, right? I do think there are certain instances where if you look, for example, there's an educational process that we can be a part of, right? We're not going to be influencing or controlling whatever the outcome is. But there are ways to coordinate and to help other people see how we can kind of come together and solve that problem. So there are ways to work together. I think at the end of the day, we're all on the same team, right? We want to see this asset thrive. We want to see it become more important and more relevant in the world as it has been for the last 15 years. And we're part of that journey.
I have heard some cool stories about Larry Fink and his journey into Bitcoin, and I've been impressed by how
money, but I think the mental flexibility to look at the facts and come around is something that we should all applaud and commend.
100%. Lee, what's your take on that question?
Yeah, I'm not going to answer it directly as asked. I'm going to ask it in terms of what Barclays, as an investment bank, is doing in the context of that question. And at our heart, we are trying to continue the mission of Bitcoiners, right, in the corporate sense. We are helping new and existing issuers that want to go acquire Bitcoin have access to the institutional bid and bridge that gap, because there's a language barrier in many cases, okay?
Huge language barrier.
Yeah. And so we're believers, and we're on your side. And what we're trying to do is we're trying to crystallize the bid in a way that works for everybody, right? And so that's effectively what we're doing. And I'll just to put it in perspective, because there was a panel a couple before this, and someone was like, well, Stretch is 80% retail and 20% institutional. Actually, no. Every single one of these IPOs is 80% institutional and 20% retail. Why? Because retail needs the validation, particularly of these new products, but they need the validation of the management team, that we've done the diligence and everything else. And then retail will come over the top, just like it's a SpaceX IPO, right? And smother that instrument and take it to where it needs to go. But the institutions are the starter fluid and the validation factor. So they're super important in that regard, because their due diligence and their structuring and their one-on-ones that we do, we don't just roll the product out to the public. We wall cross BlackRock. We wall cross 10 to 15 of our top accounts, okay? And have very deep conversations around what you want as the issuer. We've already got it all written on paper, like this is what we really want, okay? But we know there's going to be some level of concession. Maybe the cash reserve. That came out of one-on-ones with Strive. Cash reserve was not on the table in the beginning. Didn't want to give it up, not interested. You know what? At the end of the day, it was the right thing for both people. And look at it now. Strategy put the cash reserve in after their Stretch IPO, and it's one of the main factors in supporting that security today. But that came out of the institutional due diligence and the banker and the issuer all coming together in the beginning, and then retail, and then further adoption and success and everything else. And that's pretty much how the model works from our perspective. Yeah.
Jain?
I'll be quick. I mined my first Satoshi December of 2012. I was part of one of the Seattle Bitcoin communities way back when. We met at a coffee shop every weekend to talk about Bitcoin. Those were the good old days. And when I first showed up, I worked at Microsoft. I had a tucked-in collar shirt, and all the libertarians in the room were looking at me funny. It's like, who are you? Oh, the big corporate is here. We've come a long way from those days. And I would say you have to pass the institutional hurdle for this to be truly adopted by the world. I would also say, on top of the institutional demand, there is demand from actual governments around the world. We're talking about the US Strategic Bitcoin Reserve. We're talking about basically the El Salvador playbook smeared across as many countries as possible. BitGo, we do a bunch of hardcore technology for securing Bitcoin. We're working with a number of these countries, right, as we speak, to help them set up what effectively is their own version of a digital Fort Knox. The infrastructure needs to be there, both at the institutional level and at the government level, for us to truly take this to the next level. It's been many, many years since 2009. We have many, many decades to go to get this propagated around the world.
You know, not to answer my own question, but you know, I always take the view that Bitcoin's the same Bitcoin before any of the people up here bought it.
That's right.
Maybe the same Bitcoin tomorrow. But I think BlackRock after buying Bitcoin or Barclays after buying Bitcoin is a little bit different of an organization than they were beforehand. So it's like unleashed capitalism. So anyway, I thank you everyone for being on this panel. Give them a round of applause. Thank you all for sticking around with us. We got one more conversation for you. Want to shout out the live stream one more time. We got over 10,000 of you watching live. Thanks so much for tuning in. And we are going to wrap things up here with the final conversation between Dylan LeClair and Mike Belshi of BitGo. So please help me welcome them to the stage.
All right, Dylan.
Hello, hello.
Is there anybody left?
Well, we appreciate everyone that's still here. This is the last panel, I believe. And so where should we kick it off? We were just talking about the public markets. BitGo is a new entrant to the public markets this year. How are things? How are you feeling about Bitcoin, the cycle? You've seen this before. A lot of people haven't. What's the lay of the land?
Well, let's see. This is a Bitcoin-related topic tonight. So I'll only mention IPO, I guess, a little bit. I think the last crew mentioned it. You know, obviously we have traditional markets with direct access to Bitcoin by way of BlackRock and a dozen other ETFs. We got it through the DATS, et cetera. I think right now, of course, the public markets are kind of cool on crypto. I think there's number one factor is it really is AI. It's just so damn sexy that is just unstoppable for now. But then secondarily, I think people are a little bit worried about Bitcoin. I think actually quantum is a topic. I kind of hate to say it. I'm not afraid of quantum. I don't think it's a significant threat. But when we did the roadshow for the IPO, I spoke to a lot of investors, traditional investors. They don't usually talk to crypto companies. They can barely spell BTC. They're trying to figure out what we do. And it was a top 3 question. What's going on with quantum computing? Okay, I was actually really surprised because I mean we talk about it a little bit, but it's not that big of a deal. So I think we have actually, as an industry, we should pull together like ASAP and get a quantum resistant algo in the protocol. And then of course there's going to be other things to figure out with Satoshi's coins and wallets upgrading, et cetera. But as soon as that thing is in, it's just going to take this massive thing off the table. And you know, obviously there's debate about what's the best version to do it, what's space efficient and all that in terms of quantum. I think we should just put all that aside and just put one in and get going on it. And I think it'll be fine. So obviously you don't want to mess up the crypto. It does have to be sufficiently reviewed. I don't mean to be cavalier about it. But I think it's really important that we get that done fast.
Yeah, I agree there in the context of, in my opinion, and I'm not a cryptographer or a
But
quantum.
did you run into this with your investors? They ask this question?
Yeah, and our feedback is that we're paying attention to all of the stuff and all of the development, but I think in our view the perceived left tail risk is actually greater than the realized left tail.
I totally agree.
And so, nevertheless, even if it's like even if the realized left tail or the realized probability of this event or this black swan that everybody's scared about and posting on X or the bears are running with, even if it's like not even physical reality but it's just a narrative, Bitcoin would benefit from chopping that left tail off and removing it, right? It's like there's a long-standing notion that the U.S. government would ban Bitcoin, and then I think partly the night of the election, Bitcoin mooned because it was like this perceived left tail was chopped off, right? And so I think with quantum, that's kind of how we think about it. Is like, there's people now looking about it, talking about it. I think it's good that the Bitcoin community is, at least starting to talk about mobilizing. I wouldn't say they're mobilizing quite yet, but I think it's a good, it's a good topic to stress test.
Yeah, I think we've been in this industry a long time, and there's always the current FUD, and this is it. And whether it's real or not doesn't matter. If we can just keep knocking them down, we'll keep winning over the long term. So yeah, it's good. All right. Let's see. I guess digital asset treasuries. I mean, I guess you know something about those.
Yeah. I agree with you. The public markets are very cool right now.
Now, by the way, your investor base, what % is retail?
In numbers, 99%, but in share count, I would probably say 50%, 60%.
But that's still really high, right?
Yeah.
Okay. Yeah, I mean, the previous crew was talking a little bit about needing institutional investors to kind of lead for retail. So back to the IPO process. Look, I think Bitcoin could demonstrate across multiple products like yours, products like the ETFs, maybe companies like ours, that actually, that whole old school way of doing it through the institutions may not be the best way to take a company public. So if you look at companies going public, I mean, the first 6 months is a lockup period. They should call it the hedge fund play period. and every company goes through it, and then you can look at even Coinbase, the super strong company, hasn't re-hit its IPO opening price. So I know the institutional guys like to sell their book and the pricing mechanisms that they use, but I wonder if it's really serving us today. And then on the retail side, I'll tell you, so we allocated 25% to retail. I kind of wish I'd been brave enough to give 100% to retail. Somebody's got to run that experiment. The bankers will tell you it won't work. They don't really know. They'll tell you it doesn't work because that's in their vested interest, but they don't really know. But what you do get from the retail teams that we had, Fidelity, SoFi, Webull, Mumu, I don't know, we had about five different retail venues that contributed. They give you these daily stats of exactly what the retail interest in your product is. And it was, 4 or 5x oversubscribed on the total amount just by retail. Didn't need any institutional. Could have fully filled the IPO. And that's money that gets committed up front. And then the hedge funds, look, I know they got big accounts at the banks and stuff, and of course the long guys are credit worthy. But retail puts the money up. So anyway, they give you daily stats. It's way better than what the bankers do, and very interesting.
Turning the corner on this bear market, do you think the bottom is going to be driven by the retail crazy hodler maxi crowd, or is it going to be the institutional big money saying, all right, time to dip my toe in here, under the 200 week, it's, let's allocate?
I don't know. I don't know if it's too smart or not smart enough to predict price. It could go any which way. It could go down for a while. Those of us who have been in the industry, we were usually kind of hardened to this part. I think it's more frustrating for the business because you're trying to move the business forward, and we kind of got to wait until kind of the industry catches up a little bit. But I don't know if we're at the bottom yet. It could go lower, and if it does, it's fine. The thesis of Bitcoin is still completely intact. So we're in New York here. Raise your hand if you voted for Mamdani. What? You guys elected him? All right, so look, the governments are going to do what the governments are going to do, and they're going to continue to prove our thesis every single day of the week, and that'll shine through in the end. I think when people are thinking about where the price is today or tomorrow or whatever, you kind of lose, why are we really doing this? And then, the governments of the world need a way to settle transactions between them. And people are learning that, hey, if we have dollars, the U.S. could decide they don't like you because of whatever whimsical reason, and then they'll just take your money. That's a difficult place to be for most countries. Like if you're Saudi Arabia right now, you got to be thinking like, geez, do we want to be holding a bunch of these dollars? So look, I'm not trying to predict that's going to change anytime soon. It's a complicated question, but over the long arc of time, you cannot have a currency that people take away from you and yet still have it be the settlement currency. All right, so the thesis is still strong. I don't know where the price is. I don't know. How about you? Do you think we're at the bottoms yet?
Yeah, I mean, tough question, but it looks like, the interesting data, we went over this a bit earlier, but in terms of like the amount of the network and the amount of coins and UTXOs and whatever that are like at losses or are capitulating, at a loss right now, it's actually greater than what we saw in 2022, but a much lesser of a drawdown, right? So maybe it's sort of this like rounded top or a 2-year kind of, bull and a lot of institutional capital. And like, I think it was something like 80% of the actual dollars invested in the network, not like the market cap, was higher, right? So these are the levels you kind of see towards the kind of rounded end of some bear. And that doesn't mean that it's, moonshot to all-time highs. It probably means 6 months or 12 months of boredom, if you're just looking historically, and we'll see what happens. I think, there's a macro-driven effect here of like, is it rate hikes, rate cuts? That's all tea leaves, and that's probably even the only thing harder than Bitcoin to predict is what the Fed's going to do next. So it's a multifaceted question, but I think 60K, if you're waking up today with 0 Bitcoin allocation, it's a damn good time to start an allocation.
Yeah. Let's see. What do you think? You think corporations are going to pick up Bitcoin more or less now, given kind of what's going on with the Bitcoin market?
Yeah, I mean, I think what's probably the next.
And by the way, do you get non-DATs asking you for advice about whether they should put Bitcoin on their balance sheet?
Yes, less so over the last 6 months. And so there was a ton of inbound, passive inbound in Japan. After we kind of started our business and into the bull market, an interesting tidbit, and this is like a not so much an American culture thing. About 7 or 8 of the companies that have been following Metaplanet and the Treasury strategy in Japan have come out, apologized, and have pivoted, right? And so it's like 50 vol asset, these things happen, but there's not so much of an appetite for that in the public markets. It seems.
Well, I know exactly what's going on. So we're public now, right? You can look at our financials, and we've got our revenue, and then you've got where your income comes in, right? And of course on the income, if Bitcoin takes a big loss, and so we maintain, I don't know, 2,500-ish, maybe a little more Bitcoins on the balance sheet. Now we're not a DAT, right? We're an operating company, and it's what we think works well for our managing of our treasury assets. You're a public company, like there's some people that are your fans, some people want to take shots, and so then you got to show a negative number just because Bitcoin didn't do so well, and they'll pick that one out. So if you're a public company CFO, it takes some hard skin to tolerate that, because you just don't want that. You could have a stellar performance, and if you have a substantial amount of Bitcoin there, then you're still going to have like this big and have to see, and people misinterpret it. As much as the SEC tries to make all of this easy for retail investors, probably the level of sophistication around financial statements is pretty low.
Yeah, we saw the same thing with our last 2 earnings releases. It's just hugely negative net income with growing operating revenue and growing revenue, but that's overlooked, right? And so
you can make any narrative you want.
Yeah, and so it is what it is on that front. But on on the Bitcoin market, you guys, BitGo is multi-jurisdictional. What market jurisdiction or what segment are you really excited about? Do you think the next kind of phase of growth is? Obviously, the U.S. is the 10,000-ton gorilla, but are you guys looking to Asia, the Middle East, LATAM? How do you think on the next phase of the market?
Look, we operate globally, right? So we've got 7 custodial entities around the planet, and we use that as the backbone of what we call the Go network, so you can settle kind of globally. On the Bitcoin side, I think the sentiment is pretty similar across the globe right now. So I'm not sure there's been a hot zone or a cold zone. And then there's been a lot of focus on other types of products around, like stable coins, of course, people are talking about. There's been more announcements about agentic payments than there actually have been agentic payments. And then tokenized equities is what people are talking about. On the Bitcoin side, I think globally it's probably relatively flat right now.
What about the tokenized equity front and just kind of are you a believer in the 24/7, 365 nature of all financial markets? Is this kind of a crypto native pipe dream, or is this kind of where everything goes eventually?
No, that's happening. And guess what? Bitcoin deserves credit for it. Like, we created it. Like, Bitcoin made 24/7 markets. That is being followed across all markets. So that'll happen. The big entities are all doing that. On the tokenized equities front, I guess I met with Paul Atkins this week. Super happy to have him there trying to make capital markets better, more IPOs, and he's very open to experimentation of how companies grow, how you might offer tokenized types of products, and he's not afraid of it. So I think that's the biggest thing that we need is regulators are just open to it. Not everything's going to work. That's fine. And shut it down if it's not working. But let these things take root and be tried. So they're very open, and that's why here in the US, I think there's at least a dozen different tokenized equity kind of models and approaches. So we're trying to support all of those. That's obviously indirect to Bitcoin. But I do think Bitcoin still deserves credit for all of this stuff. It was the father of it all.
Does BitGo on the lending front? What are your thoughts on the Bitcoin collateralized lending? What are your thoughts on this market has kind of gone from very, very early stage to now becoming more institutional, and the cost of capital from everything I can see seems to be slowly but surely drifting closer to SOFR, but still we got a long way to go relative to what you can get at regular asset-backed securities lending. So just thoughts on the lending market. Is this obviously in every bear market there's a lot of leverage that gets wiped out. In a bull market, everybody's a genius with leverage, and Bitcoin's a volatile asset, so that comes in phases. But on a long time frame, do you view Bitcoin as like this, digital capital collateral that's great for, that's plugged in everywhere in the financial system, or it's just no leverage, spot hodl? Like, how do you think of it? What's your philosophy?
Well, the markets are growing. The Bitcoin market is just so much smaller. I'm sorry, I've been talking way too much today. No water. Okay. Let's see. The Bitcoin markets are just so much smaller. So securities lending and securities-based collateral systems are just so much out there. It's going to grow, and look, you need the markets to be connected and to get larger in order for the liquidity to flow. Bitcoin has the advantage; it does run 24/7. It also has the advantage that it's pretty much instantly liquid, kind of anywhere that you need it in large quantity. So. Thank you very much. So I think this is going to grow. It's got to grow kind of slowly. Once the markets get to a particular stage where you have crossover between Bitcoin markets and other markets, then I think we're going to see more interesting things, and you'll start seeing people taking counterparty risk on the lending. I think the crypto market since 2022 has been, I think, pretty healthy and good about not getting overextended on under-collateralized lending, counterparty credit risk. But that will return as the markets get bigger and the liquidity gets bigger.
What else? We had some notes earlier. What else did we miss? There's a.
So you asked the question of where in the world. So you guys are in Japan. You got a front row seat there. What's it like in Japan, sentiment-wise, for your product for Bitcoin? Is it also kind of cooling with the rest of the world, or is it different?
Yeah, I mean it's been a tough 12 months, or whatever the stretch has been since the.
You said stretch.
Yeah, stretch. Yeah, the talk of the town. I mean, look, I think we were number 2 to kind of pioneer the Treasury strategy and adopt it as a core asset. Companies 4 through 60 for the DAT trade happened within months after Saylor kind of spent 4 years, and we were kind of loan with him for a year or so in the public markets, doing, raising capital to acquire Bitcoin. I think it happened so fast. There was so much, with companies, 3 through 100. I think a lot of those companies too they're not really fundamental believers of Bitcoin, right? It's just opportunistic. The capital markets are open. It's time for a Dylan Coin Treasury company, right? It's like so there was a lot of froth there. I think that's been washed out. Obviously the performance has been tough for Bitcoin. It's been tough for any public equity with exposure to Bitcoin, whether that's an operating business or just the physical asset itself. But yeah, I think, the fundamental thesis, the same, the reason that people have been allocating to Bitcoin in the public markets for the past really 6 years, or Bitcoin exposure rather, is unchanged, and the retail base is definitely hardening in terms of the conviction, right? There's a lot of hot money that's come in, that's come out, but the actual investor base understands, or it's like, well, why is the stock down? Well, Bitcoin is down, right? So there's things we can control and execute on, and there's things we can't control. But long term, our conviction and our thesis hasn't changed.
Yeah, look, I think we see the same thing in the public markets in terms of interest in BitGo. The companies the firms, the investment firms that are most excited and talking to us about what we're doing tend to be crypto folks. The crypto folks have already figured out what crypto is, why it matters, how it's going to change things, what Bitcoin role in that. The traditional firms right now are very much kind of sheeping away. But we've seen this pattern, I don't know, 4 or 5 times now, right? So, look, I think this time we're going to see more sticking to it from the traditional firms for the tokenized equity side. I think there's just enough in there that it's going to make it through at least a bit. Some firms will drop out probably, but we've seen hey, we're going to be in Bitcoin, and then oops, they have a bear market, and then they decide it's not worth it for them. But the other thing that helps, of course, is the regulatory front, where now all of a sudden you don't have the worry of the government's going to come after you, and then that also percolates globally. So we have an entity in South Korea, which we hope will come live actually very, very soon. It's been 2 years in the making. I remember meeting with politicians about 1.5 years ago in South Korea, and at the time it was before Trump, right? And so America was super negative, and they're like, look, we're probably not going to pioneer safe regulation for digital assets ever, but if America ever changes, then maybe we'll follow. So that's happening right now, and that's been happening across the planet. So I think that will continue to help. And it does allow everybody to come in a way that's going to lead to good growth for all of us.
Yeah, it's a good way to wrap it up. I appreciate everyone's time here, and thanks Mike for being here.
And thank you, Dylan. Thanks everybody.
All right, well, let's give it up one more time for Dylan and Mike. Thank you, guys. Great conversation. Great way to end today's symposium. Thank you so much for joining us for BFC in NYC. I hope you had a great time. Hope you learned some things. Hope you met some people. We will be in Hong Kong next in August. I want to say thank you to our sponsors, Metaplanet, BitGo, Fidelity, VerifiedX, and Kalshi for helping us make this happen, and of course, all of our members. If you're not a member of BFC yet, we would love to talk to you about joining the network and helping us pull this off. So thanks again for coming, and we'll see you next time.
Once you've done that, then it's an education process to go and educate the equity capital markets. If the company hypothetically can generate 10% BTC yield a year, you can double Bitcoin per share over 7 years, and that's worth a premium to NAV. But if the company can generate 20% BTC yield, you can double Bitcoin per share in 3 years. That's a much faster growth rate. That's worth a higher premium to NAV. When the market sees BTC yield, right, that's sort of the dividend yield for someone on the Bitcoin standard. So if you're Bitcoin maxi on the Bitcoin standard, you're saying, okay, well, 20% would be a 20% dividend yield. And then the question becomes, okay, have you embraced the Bitcoin standard? If not, you don't recognize that as being valuable at all, right? But if yes, then yeah, that's 20%. Now, the second question is, how durable is the business model? So if I thought that would last for 10 years, I might put a P to E of 10 on it, and I might say, I'm going to multiply 10 times 20 and give you a 200% premium to your Bitcoin holdings. That works out to an MNAV of 3.